Investing, though a term many have encountered, is often more elusive to define with precision. At its core, it is the practice of allocating resources, typically money, with the expectation of generating income or appreciation over time. In essence, it is the discipline of making capital work toward future financial goals rather than remaining idle. The principal aim of investing is to understand how to build wealth, preserve purchasing power, and achieve specific financial objectives across varying time horizons. Achieving this understanding requires drawing from a broad range of disciplines. Fields such as economics, accounting, and behavioral psychology all contribute to this pursuit, as do broader studies in market history, corporate finance, and statistical analysis. There is also a role for mathematics, particularly when investment decisions require compounding calculations or risk assessment. Mathematics, after all, tends to show up at any party involving serious thought. Investors approach their subject through four main lenses: the individual security level, the portfolio construction level, the market analysis level, and the economic system level. At the individual security level, the focus is on how specific stocks, bonds, or other instruments perform, and what drives their returns. Moving up, the portfolio construction level investigates how combinations of investments behave over time and why diversification affects overall results. The market analysis level examines how entire markets function, considering factors like liquidity, efficiency, and price discovery. Finally, investment economics takes the broadest view, considering both market participants and macroeconomic forces, things like interest rates, inflation, and monetary policy, as an integrated whole. Beyond the financial intrigue, investing has practical value. Understanding investment principles helps individuals address fundamental needs, securing retirement, funding education, and building generational wealth. Investors conduct their work in a range of settings, from online brokerage platforms to financial advisory offices, and those settings can be remarkably diverse, from the individual managing a modest retirement account to the institutional fund manager overseeing billions in pension assets. Applied investing also plays a role in broader economic functions. Capital allocation determines which businesses receive funding and which innovations come to market. Investors take on a variety of roles, including that of individual portfolio manager, making decisions across retirement accounts and taxable holdings. Others serve as financial advisors, guiding clients through complex allocation decisions at multiple stages of life. Some do both. Becoming a knowledgeable investor typically starts with understanding basic financial concepts, followed by more focused learning about specific asset classes and strategies depending on one's goals and circumstances. A solid grasp of compounding mathematics, risk-return relationships, and market history is essential, which is unfortunate for anyone hoping to avoid numbers altogether. On a practical level, many forces, both market-driven and psychological, shape investment outcomes. The investment landscape, while vast in its offerings, occupies a surprisingly accessible space for those willing to learn its fundamental principles. It stretches from simple savings accounts, earning minimal interest, to complex derivatives traded across global markets. Its participants, ranging from novice savers to sophisticated institutions, are guided by time-tested principles which together dictate which strategies will succeed where. And so, while investing may start with questions about stocks and bonds, it ends with insights about financial security itself. Understanding where and how capital flows across the financial landscape requires examining the structure of markets themselves. The structure of financial markets encompasses the study of where capital concentrations occur across the globe and the economic factors that shape those patterns. These factors, things like regulatory environments, currency stability, and market infrastructure, vary largely with economic development and geographic location. As these conditions shift, so too do the investment opportunities and capital flows they support. Imagine embarking on an investment journey starting with the most developed markets and moving toward emerging economies. Initially, you would find yourself in the United States, home to the world's largest stock market by capitalization. The New York Stock Exchange and Nasdaq combined represent roughly 40 to 45% of global equity market value, a concentration of capital unmatched anywhere else. As you move beyond North America, these give way to other developed markets. Europe, Japan, and Australia offer mature exchanges with deep liquidity and established regulatory frameworks. The infrastructure becomes recognizable, the rules transparent. And by the time you reach what market analysts categorize as emerging markets, the landscape shifts noticeably. Countries like China, India, and Brazil present opportunities defined by higher growth potential, but also by increased volatility and less developed financial infrastructure. Keep exploring and you encounter frontier markets, the least developed of publicly accessible exchanges, where liquidity thins considerably and regulatory oversight varies widely. Moving through this progression, you find yourself in markets where only the most risk-tolerant investors venture, adapted to handle significant uncertainty in exchange for potential outsized returns. This gradual transition mirrors not only the shift in economic development, but also the succession of investment characteristics finely tuned to those changing conditions. And yet similar variations in market structure can be found even without shifting across borders. Different asset classes within the same country often function as distinct ecosystems. The bond market operates differently from the equity market. Real estate investment trusts follow their own patterns. Commodity futures trade under separate mechanisms entirely. Interestingly, markets at the same development level do not always resemble one another. Currency flows and trade relationships, phenomena like the dollar's reserve currency status and regional trade agreements, help explain why capital allocation is a global dynamic with many interconnected players. Investors interested in market geography examine these patterns of capital distribution. No investment vehicle is truly universal. Take the Japanese government bond, for instance. While technically available to international investors, it serves primarily domestic Japanese institutional needs, with yields that reflect Japan's unique economic circumstances and investor base. Such instruments are effectively endemic to their home markets, shaped by local monetary policy and cultural saving patterns. In contrast, widely held securities like shares of major multinational corporations or US Treasury bonds range across global portfolios, accessible through most developed market brokerage systems. The distribution of capital is shaped over long economic timescales, influenced by both institutional development and regulatory evolution. Market geography has been intertwined with economic theory since the establishment of modern exchanges in the 17th century. As traders and policymakers noticed that the most sophisticated financial centers emerged in regions with stable legal systems, reliable property rights, and free capital movement. London's position as a financial hub, built over centuries, exemplifies this pattern. The city is estimated to handle between 35 and 40% of global foreign exchange transactions, a concentration that reflects historical development, favorable regulation, and network effects that prove difficult to replicate elsewhere. The infrastructure has been remarkably effective at attracting international capital while maintaining local market integrity. Sometimes understanding where capital flows do not reach is just as revealing. Many developing economies, for example, maintain capital controls that restrict how money moves across their borders. These barriers, whether implemented to manage currency stability or retain domestic investment, create distinct market characteristics. An investor in such markets faces restrictions on repatriation of profits, limits on foreign ownership percentages, or mandatory local partnerships. China's A-share market, historically restricted to domestic investors, operated in relative isolation for decades before gradually opening to foreign participation through quota systems and designated access channels. This selective permeability shaped both the market's behavior and its investor composition in ways that persist today. Investment instruments follow similar patterns of geographic concentration and dispersion. Some markets develop deep liquidity in particular asset types. The United States dominates corporate bond issuance, with a market exceeding $10 trillion. Germany's financial system, by contrast, traditionally relied more heavily on bank lending than bond markets, creating a different capital structure across similar economies. Switzerland specializes in private banking and wealth management services that draw clients globally. These geographic specializations reflect regulatory choices, historical development paths, and cultural approaches to saving and investment. Market accessibility represents another dimension of financial geography. Developed markets typically offer straightforward account opening, transparent pricing, and reliable settlement systems. Transaction costs remain low, often just a few basis points, for liquid securities. Information flows freely through standardized disclosure requirements and active financial media. These conditions support efficient price discovery and encourage broad participation. Emerging markets present a different profile entirely. Infrastructure gaps may result in settlement delays, custody challenges, or less reliable corporate governance. Currency convertibility issues can complicate repatriation of profits. Political risk, while present everywhere, becomes more pronounced in markets where property rights face greater uncertainty or regulatory frameworks shift unpredictably. These factors manifest as a risk premium. The additional return investors demand to compensate for these complications. An emerging market equity index might offer expected returns several percentage points higher than developed market equivalents, reflecting these added considerations. The investment landscape continues to evolve. Markets once considered emerging graduate to developed status as their infrastructure improves and their economies mature. South Korea and Taiwan made this transition in the view of major index providers. Electronic trading platforms and financial technology innovations reduce some traditional barriers to market access, though regulatory and currency challenges persist. The fundamental principle remains consistent across this diversity. Capital seeks returns adjusted for risk and accessibility, flowing toward opportunities where the compensation justifies the complications involved. Beyond geography, one fundamental force shapes all investment decisions at every market level and across all asset types. Time value of money, though a concept many have encountered in passing, represents the mathematical foundation upon which all investment analysis ultimately rests. The principle states that money available today possesses greater worth than an identical amount receivable in the future, a difference attributable to the potential for current funds to generate returns over the intervening period. This relationship between present and future value governs decisions ranging from bond pricing to retirement planning, from corporate capital budgeting to personal savings strategies. The mechanism underlying this principle is compounding, the process by which investment returns themselves generate additional returns over successive periods. Consider a straightforward example. An investor places $1,000 into an account earning 7% annually. After 1 year, the account holds $1,070, representing the original principal plus $70 in interest. In year 2, however, the 7% return applies to the entire $1,070 balance, generating $74.90 rather than another $70. This additional $4.90 interest earned on previously accumulated interest exemplifies compounding at work. The effect appears modest in early years, but accumulates substantially over extended periods. Over time, compounding produces results that diverge dramatically from simple linear growth. That same $1,000 investment, maintained at 7% annually for 30 years, grows to approximately $7,612. The investor contributes nothing beyond the initial sum, yet the account increases more than sevenfold. This multiplication stems entirely from returns building upon returns, each year's gains serving as the foundation for subsequent growth. The mathematician Albert Einstein, whether he actually said it or not, is famously credited with calling compound interest the eighth wonder of the world, noting that those who understand it earn it while those who do not pay it. The quote may be apocryphal, but the observation holds regardless. The frequency with which returns compound affects final outcomes, though perhaps less dramatically than intuition might suggest. Annual compounding, as in the previous example, applies returns once per year. Monthly compounding divides the annual rate across 12 periods and applies it 12 times. Daily compounding repeats this process 365 times. Each increase in frequency produces marginally better results. That $1,000 at 7% for 30 years yields approximately $7,812 with annual compounding, $7,738 with monthly compounding, and $7,767 with daily compounding. The differences, while measurable, remain relatively modest for typical interest rate levels. What matters far more is time itself and the rate of return earned. The concept of present value reverses this logic, working backward from future amounts to determine their equivalent worth today. An investor expecting to receive $10,000 in 10 years faces a question. What is that future sum worth now? The answer depends on the rate of return available during the intervening decade, often called the discount rate. If prevailing rates stand at 5%, the present value of that future $10,000 equals approximately $6,739. This figure represents the amount that, invested today at 5%, would grow to exactly $10,000 in 10 years. Present value calculations underlie bond pricing, pension liability assessments, and virtually all long-term financial projections. Interest rates function as the price of time, the compensation required to defer consumption or the cost incurred to access funds immediately rather than waiting. These rates vary considerably across different instruments and time horizons. A savings account might offer 0.5%, a 10-year Treasury bond perhaps 4%, while a corporate bond from a less creditworthy issuer could yield 8 or 9%. Each rate reflects distinct considerations regarding risk, liquidity, and duration, but all represent fundamentally the same exchange, current resources for future returns, or vice versa. A useful shortcut for estimating compounding effects is the Rule of 72, a mental calculation that approximates how long an investment takes to double. Dividing 72 by the annual return percentage yields a rough estimate of the doubling period in years. An investment returning 6% annually doubles in approximately 12 years, 72 divided by 6. At 9%, the doubling time falls to roughly 8 years. At 3%, it extends to 24 years. The rule provides only an approximation, growing less accurate at extreme interest rates, but serves effectively for typical return ranges between 3 and 12%. The calculation offers investors an intuitive grasp of compounding power without requiring financial calculators or spreadsheets. The mathematical formulas governing these relationships, while precise, need not intimidate. Future value equals present value multiplied by 1 plus the interest rate, raised to the power of the number of periods. Present value equals future value divided by that same expression. These equations, though expressed in algebraic notation, simply formalize the logic already described. Present sums grow over time when earning returns. Future sums must be discounted to reflect the returns forgone by receiving payment later rather than sooner. The mathematics merely quantifies intuitions most people already possess regarding the value of money across time. Real-world applications appear everywhere in finance. A corporate bond promising $1,000 at maturity 10 years hence trades today at whatever price makes its yield competitive with alternatives. A pension fund projects liabilities decades forward, then discounts them to determine how much must be set aside now to meet those obligations. A retiree choosing between a lump sum pension payout or monthly payments for life performs an implicit present value comparison, weighing immediate access to capital against guaranteed future income streams. Each decision fundamentally asks the same question. What is the appropriate exchange rate between money now and money later? Historical examples demonstrate compounding's long-term significance. An investment in US stocks during the mid-20th century, allowed to compound undisturbed for 50 or 60 years, produced returns that transformed modest initial positions into substantial wealth. The Dow Jones Industrial Average, to take one benchmark, stood around 200 in 1950 and exceeded 30,000 by 2020, not accounting for dividends reinvested along the way. An investor who committed funds early and maintained that position through multiple market cycles captured compounding across decades. The gains accumulated not smoothly, but through the mathematics of multiplicative growth applied repeatedly despite intervening volatility. Inflation introduces a complication, distinguishing nominal returns from real returns. A 7% nominal return sounds attractive until one accounts for 3% annual inflation. The real return, the actual increase in purchasing power, equals roughly 4%. Present and future value calculations ideally use real rates when projecting long-term outcomes, ensuring that projections reflect genuine wealth growth rather than merely keeping pace with rising prices. Investors focused solely on nominal figures risk underestimating the capital required to maintain living standards across retirement spans that might extend 20 or 30 years. The time value of money, at its essence, transforms investing from a static exercise into a dynamic accumulation process. It explains why starting early matters so profoundly, why even modest savings compound into meaningful sums given sufficient time, and why short-term thinking systematically undervalues long-term outcomes. The principle operates independently of market conditions or investment skill, a mathematical certainty that favours patience and consistency. In this case, the power of investing emerges not from complexity or sophistication, but from respecting time's compounding effect and structuring financial decisions accordingly. The relationship between potential gain and potential loss, however, introduces a second fundamental principle that governs every deployment of capital. Risk influences investing at every level, from the volatility of individual securities to the stability of entire portfolios across decades. At the fundamental level, risk represents the variability of returns, the degree to which actual outcomes deviate from expectations. This concept, while straightforward in definition, manifests in numerous forms across the investment landscape. Most investors perform optimally within a narrow risk tolerance band. Below their comfort threshold, potential returns fail to justify the effort and opportunity cost of investing. Above it, anxiety and poor decision-making disrupt the careful execution required for long-term success. This is why, relatively, few portfolios achieve ideal risk-return positioning, although with proper planning and self-awareness, most investors can approximate it. To succeed, investors must either structure portfolios within their psychological comfort zone or restrict themselves to risk exposures that remain tolerable during market turbulence. Some have developed mechanisms to endure fluctuations, such as automatic rebalancing that removes emotional decision-making, or disciplined asset allocation that accepts volatility as the price of long-term growth. Certain institutional investors, pension funds, and endowments with decades-long time horizons have taken risk management a step further, maintaining positions through severe drawdowns that would devastate individual investors lacking similar staying power. Risk also plays a central role in determining expected returns across asset classes. The risk-return trade-off represents one of investing's most fundamental relationships. Higher potential returns require accepting greater uncertainty about outcomes. Lower volatility comes at the cost of reduced long-term growth prospects. This trade-off is not negotiable. No investment offers both high returns and low risk sustainably, at least not once market participants recognize its characteristics and bid up its price accordingly. Any apparent exception signals either hidden risks not yet fully understood or temporary market inefficiencies that vanish once discovered. Historical data illustrate this principle clearly. US stocks have returned approximately 10% annually over the past century, though with substantial year-to-year variability. Individual calendar years have ranged from losses exceeding 40% to gains surpassing 50%. Bonds, by comparison, have delivered roughly 5% average annual returns, with considerably less fluctuation. Typical annual swings ranging from -5% to +20%, rather than the wider extremes seen in equities. Cash equivalents, the safest major asset class, have provided 2 to 3% returns with minimal variation. Each asset class positions differently along the risk-return spectrum, offering distinct combinations of expected gain and expected volatility. Standard deviation, a statistical measure borrowed from broader mathematics, quantifies this volatility in precise terms. It calculates how widely returns disperse around their average, providing a numerical summary of an investment's tendency toward extreme outcomes. A stock with 20% standard deviation experiences returns roughly within 20 percentage points of its average in about 2/3 of years, a considerable range. A bond with 5% standard deviation fluctuates far less. Investors seeking higher returns must accept higher standard deviations, a mathematical relationship that holds across virtually all liquid markets over meaningful time periods. Risk manifests in multiple distinct forms beyond simple price volatility. Market risk, the tendency for entire markets to rise and fall, affects nearly all publicly traded securities to some degree. Even the most carefully selected stock portfolio cannot escape broad market declines entirely, as the financial crisis of 2008 demonstrated when correlations across securities approached unity and diversification benefits temporarily disappeared. Credit risk, the possibility that a borrower fails to repay obligations, particularly affects bond investors who must assess whether issuers will meet interest payments and return principal at maturity. Corporate bonds carry more credit risk than government bonds, with compensation arriving through higher yields. Inflation risk erodes purchasing power over time, a gradual threat that proves especially dangerous for conservative portfolios heavy in cash and short-term bonds. An investor holding assets that return 2% while inflation runs at 3% loses real wealth annually despite nominal gains. This form of risk, often overlooked during periods of price stability, has periodically devastated fixed income investors during inflationary episodes like the 1970s, when bond returns fail to keep pace with rising prices. Liquidity risk arises when investors cannot sell positions quickly without accepting steep discounts. Small-cap stocks, corporate bonds from less prominent issuers, and alternative investments often carry liquidity premiums, higher expected returns that compensate for the difficulty of exiting positions at fair prices. Currency risk affects international investments, introducing variability from exchange rate movements. A US investor purchasing European stocks faces two sources of return: the stock's performance in euros and the euro's movement against the dollar. Favorable stock returns can be negated by unfavorable currency shifts, while unfavorable stock performance might be offset by favorable currency movements. This additional source of volatility makes international investing more complicated than purely domestic allocation, though the diversification benefits often justify accepting this added complexity. Risk tolerance and risk capacity represent related but distinct concepts. Tolerance describes an investor's emotional ability to withstand losses without panicking and making poor decisions. Capacity describes the financial ability to absorb losses without compromising essential goals. A young professional with decades until retirement possesses high risk capacity, time allowing recovery from even severe market downturns. If that same individual loses sleep during market volatility and sells at inopportune moments, however, they demonstrate low risk tolerance. The effective portfolio respects whichever constraint binds more tightly. Assessment of personal risk tolerance often begins with questionnaires probing reactions to hypothetical scenarios. How would you respond if your portfolio lost 20% in a month? Would you invest more, hold steady, or reduce risk? These instruments provide rough guidance but cannot perfectly predict behavior during actual market stress. Many investors discover their true risk tolerance only when markets turn severely negative, a delayed revelation that can prove costly if it triggers sales near market bottoms. Historical episodes provide sobering context for understanding realistic risk levels. October 1987 saw the US stock market fall 22.6% in a single day, an event that remains the largest one-day percentage decline on record. The tech bubble burst between 2000 and 2002, erased roughly half the value of the Nasdaq Composite Index over 30 months. The financial crisis of 2008 brought a 57% peak-to-trough decline in the S&P 500, with maximum losses occurring in early 2009. These drawdowns, while temporary in retrospect, felt permanent and terrifying to those experiencing them in real time. Investors who maintained positions through these periods ultimately recovered and prospered. Those who sold in fear often locked in losses and missed subsequent recoveries. Diversification represents the primary tool for managing portfolio risk. By combining investments that do not move in perfect lockstep, investors reduce overall portfolio volatility without necessarily sacrificing expected returns. Stocks and bonds demonstrate this principle. They often move in opposite directions during market stress, with investors fleeing equities for the relative safety of government bonds. A portfolio holding both asset classes experiences less extreme fluctuations than one concentrated entirely in stocks, while maintaining returns substantially above a pure bond portfolio. The mathematics of diversification reveal that benefits accumulate most rapidly from initial additions. A portfolio of two uncorrelated investments reduces volatility compared to either held individually. Adding a third and fourth investment brings further reductions. However, beyond roughly 20 to 30 distinct holdings in a stock portfolio, additional diversification provides diminishing benefits. At some point, portfolios become over-diversified, holding so many positions that superior investments get diluted by mediocre ones, while management complexity increases. This threshold varies by asset class and market conditions, but suggests that more holdings do not automatically improve portfolios. Portfolio construction combines these risk concepts into practical allocation decisions. Aggressive investors seeking maximum long-term growth might hold 90% stocks and 10% bonds, accepting considerable short-term volatility for higher expected returns. Moderate investors might prefer a 60-40 split, balancing growth against stability. Conservative investors, particularly those near or in retirement, might reverse the ratio to 30% stocks and 70% bonds, prioritizing capital preservation over growth. Each allocation reflects a different position on the risk-return trade-off, with no universally correct answer. The appropriate choice depends on individual circumstances, goals, and psychological makeup. Not exactly comfortable when portfolio statements arrive during downturns, but effective for those who maintain discipline. Investment success demands matching portfolio risk to personal capacity and tolerance, then maintaining that allocation through inevitable market turbulence, rather than abandoning strategy when conditions deteriorate. Portfolio growth and the total accumulation of wealth depends heavily on how investors allocate capital across major asset categories, the building blocks of diversified portfolios. The concept of asset allocation addresses a fundamental question in portfolio construction. How should capital be divided among different categories of investments to optimize risk-adjusted returns? Research conducted over several decades, most notably studies by Brintzen, Hood, and Biebauer in the 1980s and 1990s, determined that asset allocation decisions account for more than 90% of portfolio return variability over time. Security selection and market timing, the activities that capture most investor attention and effort, contribute relatively little to long-term outcomes by comparison. This finding, controversial when first published but subsequently validated through additional research, suggests that getting the broad allocation right matters far more than identifying specific winning investments within categories. Three major asset classes dominate most investment portfolios: equities representing ownership stakes in corporations, fixed income securities, primarily bonds that constitute loans to governments or companies, cash equivalents, including money market funds, savings accounts, and short-term treasury bills. Each class exhibits distinct characteristics regarding expected returns, volatility, income generation, and correlation with other investments. The combination selected determines portfolio behavior far more than the particular stocks or bonds chosen within each category. Equities offer the highest expected long-term returns among major asset classes, but come with substantial volatility. Historical data spanning the past century shows US stocks returning approximately 10% annually on average, though individual years vary dramatically from that mean. The range extends from losses exceeding 40% during severe downturns to gains surpassing 50% during strong bull markets. This volatility reflects the residual claim equity holders possess. Stockholders receive whatever value remains after all company obligations are met, capturing full upside when businesses prosper, but bearing full downside when they struggle. Standard deviation for broad stock indices typically runs between 15 and 20% annually. Quantifying this considerable variability, stocks generate returns through two mechanisms: capital appreciation as share prices increase, and dividend payments as companies distribute profits to shareholders. Growth-oriented companies often pay minimal or no dividends, reinvesting all earnings into expansion. Mature, stable companies frequently pay substantial dividends, providing steady income streams alongside more modest price appreciation. Total return combines both components, with historical data indicating that reinvested dividends account for a significant portion of long-term equity returns, perhaps 40% or more, depending on the period examined. Fixed income securities, by contrast, offer lower expected returns in exchange for reduced volatility and more predictable income. Bonds have returned roughly 5% annually over long periods, with standard deviations typically ranging from 4 to 8%, depending on bond type and duration. Investment-grade corporate bonds, those rated BBB or higher by credit agencies, fall toward the lower end of this volatility range. Longer maturity bonds and lower credit quality issues experience greater price fluctuations. Bond returns derive primarily from interest payments, with price appreciation or depreciation playing a secondary role unless interest rates move substantially during the holding period. The relationship between bond prices and interest rates operates inversely. When prevailing rates rise, existing bonds paying lower rates decline in value, as new issues offer better yields. When rates fall, existing higher-yielding bonds appreciate as they become more attractive relative to new lower-yielding alternatives. This interest rate sensitivity, measured by duration, increases with bond maturity. A 30-year Treasury bond exhibits far more price volatility than a 2-year note, despite both carrying the same credit quality. Investors selecting bonds must balance yield against this duration risk, accepting lower rates on short-term securities to minimize price fluctuations or demanding higher rates on long-term bonds to compensate for increased volatility. Cash equivalents anchor the conservative end of the asset class spectrum. Money market funds, savings accounts, and treasury bills provide minimal returns, currently ranging from 0.5 to 5%, depending on Federal Reserve policy and prevailing short-term rates. Volatility remains negligible, with principal preservation the primary objective. These investments serve specific purposes. Emergency funds, money needed within months or a few years, or capital awaiting deployment into longer-term positions. Holding substantial portfolio percentages in cash for extended periods effectively guarantees real wealth erosion after accounting for inflation and taxes. The safety feels comfortable, but the opportunity cost compounds significantly over time. Liquidity determines how quickly and efficiently investors can convert assets into cash without accepting substantial price concessions. This characteristic, often overlooked during stable market periods, becomes critical during emergencies, market dislocations, or when opportunities requiring immediate capital arise. Portfolios face the persistent challenge of balancing investment returns against the need for accessible funds. Too much liquidity sacrifices long-term growth. Too little creates vulnerability to forced sales at unfavorable prices when cash needs arise unexpectedly. To manage this tension, investors have developed a hierarchy of holdings based on conversion speed and reliability. Cash itself, held in checking or savings accounts, provides immediate access but minimal returns. Money market funds and treasury bills convert to cash within days, offering slightly higher yields while maintaining near-perfect liquidity. Publicly traded stocks and bonds, held in brokerage accounts, typically settle within 2 business days, though market prices fluctuate continuously. Real estate, private equity stakes, and collectibles might require months to sell at fair values, sometimes longer during market stress. Each step along this spectrum trades immediacy for potentially higher returns. The liquidity spectrum reflects a fundamental economic principle. Assets that can be quickly converted to cash at predictable prices command premium valuations, resulting in lower yields. Investors pay for convenience and certainty through accepting reduced returns. Conversely, illiquid investments must compensate holders through higher expected returns to justify the complications and risks associated with difficult or uncertain exit processes. This liquidity premium, the additional return earned by accepting reduced marketability, varies across asset types and market conditions, but persists as a structural feature of capital markets. Emergency funds represent the foundation of liquidity planning for individual investors. Financial advisors typically recommend maintaining 3 to 6 months of essential living expenses in highly liquid, stable value accounts. This reserve serves multiple purposes: job loss protection during unemployment searches, medical emergency funding when insurance coverage proves inadequate, major home or vehicle repairs that cannot be deferred. These contingencies, while hopefully rare, can devastate long-term financial plans if they force premature liquidation of investments during market downturns or trigger high-interest debt accumulation. The appropriate emergency fund size depends on employment stability, income volatility, health status, and insurance coverage quality. A dual-income household with stable jobs and comprehensive insurance might manage comfortably with 3 months of expenses reserved. A single-income household, self-employed individual, or anyone with variable income streams should probably maintain closer to 6 months or even more. The calculation focuses on essential expenses only, excluding discretionary spending that could be eliminated during genuine emergencies. Housing payments, utilities, food, insurance premiums, and minimum debt payments comprise the core. Cash equivalents provide the vehicles for maintaining these emergency reserves and other short-term savings. High-yield savings accounts currently offer interest rates ranging from 4 to 5%, depending on the financial institution and account balance requirements. Money market funds, which invest in short-term government and corporate debt, provide similar yields with check-writing privileges and effectively stable share prices, though unlike bank accounts, they lack FDIC insurance protection. Certificates of deposit offer slightly higher rates in exchange for locking funds away for specified terms, typically 3 months to 5 years, with early withdrawal triggering penalty fees. Treasury bills, short-term government securities maturing in 4, 8, 13 or 26 weeks, represent another cash management option. These instruments trade in highly liquid markets, carry no credit risk given government backing, and generate income exempt from state and local taxes. Current yields often exceed savings account rates, making them attractive for investors comfortable with the modest additional complexity of purchasing through brokerage accounts or the Treasury Direct system. The settlement process requires slightly more planning than simply withdrawing from a savings account, but the liquidity remains substantial. Interestingly, holding too much cash creates its own problems beyond just opportunity cost. Inflation erodes purchasing power continuously, a process that accelerates during periods of elevated price growth. An investor maintaining $50,000 in a savings account, earning 4% while inflation runs at 3%, preserves purchasing power marginally. If inflation rises to 5%, that same account loses real value despite nominal gains. The cash feels safe because the dollar balance never declines, but its command over goods and services diminishes year by year. Bid-ask spreads represent another dimension of liquidity cost, particularly relevant for actively traded securities. The bid price is what buyers currently offer for an asset. The ask price is what sellers currently demand. The difference between them, the spread, compensates market makers for providing liquidity by standing ready to buy or sell. Highly liquid securities like large-cap stocks or treasury bonds exhibit tiny spreads, often just a few cents per share or a few basis points of bond value. Thinly traded securities, small-cap stocks or corporate bonds from less prominent issuers can show spreads of several percent, substantially increasing the real cost of entering or exiting positions. Real estate demonstrates extreme illiquidity in practical terms. Selling a property typically requires listing with agents, marketing to potential buyers, negotiating offers, completing inspections and appraisals, securing buyer financing, and navigating closing procedures. The entire process commonly spans 2 to 6 months under favourable conditions, longer during market downturns when buyers grow scarce. Transaction costs, including agent commissions, transfer taxes, and various fees, often total 6 to 10% of sale price. An investor forced to sell real estate quickly usually accepts below market prices, sometimes substantially so, making it entirely unsuitable for emergency funds or any capital that might be needed within several years. A practical example illustrates these principles in action. During the 2008 financial crisis, money market funds, previously considered perfectly safe and liquid, experienced severe stress. One prominent fund, the Reserve Primary Fund, broke the buck, meaning its share price fell below the standard $1 value after holdings of Lehman Brothers debt became worthless following that firm's bankruptcy. Investors rushed to withdraw funds, creating liquidity pressure across the entire money market sector. The government ultimately intervened with guarantees to prevent broader system collapse. But the episode demonstrated that even seemingly risk-free cash equivalents carry subtle vulnerabilities during extreme market stress. A surprisingly complex situation for an otherwise routine cash management vehicle. Other investment considerations also shape portfolio construction, though none exert the fundamental influence of asset allocation, risk management, and liquidity planning. Inflation, though less immediately visible than market volatility or asset allocation decisions, exerts continuous pressure on investment outcomes. It represents the rate at which prices for goods and services rise over time, eroding the purchasing power of static dollar amounts. An investment returning 6% nominally provides only 3% real return if inflation runs at 3% annually. This distinction between nominal and real returns fundamentally matters for long-term investors whose portfolios must maintain purchasing power across decades, not merely preserve dollar values. Historical inflation has averaged roughly 3% in the United States over the past century, though with considerable variation ranging from negative rates during deflationary periods to double-digit levels during the 1970s stagflation era. The impact accumulates substantially over time. At 3% annual inflation, purchasing power halves approximately every 24 years. An investor requiring $50,000 annually to maintain their lifestyle today would need roughly $100,000 in 24 years simply to purchase equivalent goods and services, assuming no lifestyle improvements. Portfolios earning returns below inflation rates, after accounting for taxes and fees, guarantee real wealth erosion regardless of nominal account balance growth. This makes cash and low-yielding bonds particularly vulnerable during inflationary periods, as their modest returns often fail to outpace price increases. Tax considerations represent another persistent drag on returns, affecting after-tax wealth accumulation more significantly than many investors recognize. Investment income faces federal taxation and, in most states, additional state taxes. Interest income from bonds, savings accounts, and money market funds receives ordinary income tax treatment, with rates ranging from 10 to 37%, depending on total income. Dividend income falls into two categories: qualified dividends, meeting specific holding period and corporate structure requirements, face preferential rates of 0, 15, or 20%. Non-qualified dividends receive ordinary income treatment at potentially much higher rates. Capital gains, profits from selling appreciated assets, also receive different treatment based on holding period. Short-term gains on assets held 1 year or less face ordinary income rates. Long-term gains on assets held longer than 1 year benefit from preferential rates matching qualified dividend treatment, 0, 15, or 20% for most taxpayers. This distinction creates strong incentives for long-term holding periods, as the tax differential between short-term and long-term treatment can exceed 15 percentage points for high-income investors. A 37% ordinary income tax compared to a 20% long-term capital gains rate represents an 85% increase in tax burden for identical pre-tax gains. Investment fees and expenses compound the erosion of returns over time. Mutual funds charge expense ratios covering management, administrative, and marketing costs, with annual fees ranging from as low as 0.03% for broad index funds to 1.5% or more for actively managed offerings. The difference appears modest in isolation, but accumulates dramatically. An investment of $100,000, growing at 8% annually for 30 years, reaches approximately $940,000 after a 0.1% annual fee. The same investment subjected to a 1% annual fee grows to only about $680,000, a difference of $260,000, or roughly 28% less wealth accumulated. The higher fee investment must generate returns a full percentage point higher just to match the lower fee alternative, a consistent performance edge that proves difficult to achieve and sustain. Currency risk affects international investments, introducing an additional source of return variability. A US investor purchasing Japanese stocks experiences returns determined by both stock price movements in yen and exchange rate fluctuations between yen and dollars. If Japanese stocks gain 10% in local currency, but the yen weakens 5% against the dollar, the US investor captures only approximately 5% total return. Conversely, favorable currency movements can enhance returns beyond local market performance. This additional volatility makes international investing more complex than purely domestic allocation, though diversification benefits often justify accepting this complication. Interest rate sensitivity, particularly relevant for bond investors, measures how bond prices respond to changing yield environments. Duration quantifies this relationship, expressing the approximate percentage price change for a 1% move in interest rates. A bond with 5 years duration falls roughly 5% in price if yields rise 1%, or gains approximately 5% if yields fall 1%. Longer maturity bonds exhibit higher duration and therefore greater interest rate risk. This creates a fundamental tension in fixed income portfolios between locking in higher yields through longer maturities and maintaining flexibility through shorter duration positions less vulnerable to rate increases. Finally, investment account structures introduce their own set of rules and consequences that substantially affect long-term wealth accumulation. The type of account holding investments determines tax treatment, contribution limits, withdrawal rules, and estate planning implications, sometimes more dramatically than the investments themselves. Investment accounts across the financial landscape are broadly categorized into taxable and tax-advantaged structures. Tax treatment divides investment accounts into two broad categories, each with distinct rules governing contributions, growth, withdrawals, and estate planning. Tax-advantaged accounts, designed primarily for retirement savings and specific goals like education or healthcare, exhibit considerable diversity and are grouped into several major types to help organize the complexity of available vehicles. While these categories prove useful for planning purposes, they inevitably mask finer operational details. The difference between a traditional IRA held by a 35-year-old professional in California and a Roth IRA maintained by a 65-year-old retiree in Florida extends far beyond simple tax treatment. Both qualify as retirement accounts, but each serves fundamentally different financial strategies. 7 principal account types dominate individual investment planning: traditional IRAs, Roth IRAs, employer-sponsored 401k plans, and their variants, taxable brokerage accounts, 529 education savings plans, health savings accounts, and custodial accounts for minors. Each is defined by characteristic rules regarding contribution limits, tax treatment of deposits and withdrawals, and restrictions on accessing funds. Annual legislative changes periodically adjust these parameters, but the fundamental structures remain relatively stable. While an account can be associated with specific life stages, similar financial needs can be met through different account combinations, depending on employment situation, income level, and personal circumstances. Some accounts, like traditional IRAs and 401k plans, provide immediate tax deductions on contributions but require paying ordinary income tax on all withdrawals. Others, such as Roth IRAs and Roth 401k, reverse this sequence, accepting after-tax contributions in exchange for tax-free withdrawals meeting specific requirements. In contrast, taxable brokerage accounts offer no tax advantages on contributions or growth, but impose no restrictions on access or usage, providing flexibility that retirement accounts cannot match. The particular advantages and constraints of each account type result in different optimal uses depending on individual circumstances. Contribution limits constrain how much can be deposited annually into most tax-advantaged accounts. Traditional and Roth IRAs currently permit $7,000 per year, with an additional $1,000 catch-up contribution for those aged 50 and older. Employer-sponsored 401k plans allow substantially more, $23,000 for 2024, with a $7,500 catch-up provision. These limits increase periodically with inflation adjustments, but remain well below the amounts high-income earners might prefer to shelter from taxation. The constraints force strategic decisions about which accounts to fund first and how to prioritize competing savings goals. Other biomes, such as deserts and tundra, are less productive due to harsh tax treatment and limited contribution capacity. The identity of each account type lies not in a single feature, but in its distinct combination of tax treatment on contributions, growth, and withdrawals paired with rules governing access and required distributions. Withdrawal rules and penalties significantly affect account selection and usage patterns. Most retirement accounts impose a 10% penalty on distributions taken before age 59 and a half, deterring early access to funds intended for later life. Exceptions exist for specific circumstances, including first home purchases, qualified education expenses, and certain medical costs. But these carve-outs come with limitations and documentation requirements that complicate planning. Traditional retirement accounts also mandate required minimum distributions beginning at age 73, forcing withdrawals whether needed or not, and potentially pushing retirees into higher tax brackets during years they would prefer to minimize distributions. 529 education savings plans face different constraints, limiting tax-free withdrawals to qualified education expenses as defined by federal law. Non-qualified withdrawals trigger ordinary income tax plus a 10% penalty on earnings, though contributions can always be recovered tax-free since they were made with after-tax dollars. Health savings accounts permit tax-free withdrawals only for qualified medical expenses before age 65, after which they function more like traditional IRAs with penalty-free but taxable distributions for any purpose. Each account type embeds specific incentives and disincentives designed to encourage intended uses while discouraging others. Taxable brokerage accounts operate under entirely different principles. No contribution limits exist beyond the practical constraint of available capital. No withdrawal restrictions apply, allowing complete flexibility regarding timing and usage. Investments can be held indefinitely or sold immediately without penalties. This freedom comes at a cost, the loss of tax-deferred or tax-free growth, and the requirement to pay taxes annually on dividends, interest, and realized capital gains. For long-term buy-and-hold investors, however, taxable accounts offer significant advantages, including basis step-up at death, favorable long-term capital gains rates, and the ability to strategically harvest losses to offset gains. Account selection depends on multiple factors working in combination. Income level affects which accounts remain available and which provide maximum tax benefits. Employment status determines access to workplace retirement plans. Age influences contribution limits through catch-up provisions and affects withdrawal penalty applicability. Financial goals, retirement versus education funding versus general wealth building, point toward appropriate account types. No single answer applies universally, requiring personalized analysis of individual circumstances. Traditional IRAs and Roth IRAs represent the foundation of individual retirement planning for those with access to these vehicles. Traditional individual retirement accounts were established by the Employee Retirement Income Security Act of 1974, creating tax-advantaged retirement savings vehicles accessible to workers without employer-sponsored plans. The fundamental structure offers tax deductions on contributions made during working years, tax-deferred growth on investments held within the account, and ordinary income taxation on withdrawals during retirement. This framework assumes that most workers face higher tax rates during their careers than in retirement, making immediate deductions valuable and future taxation at lower rates acceptable. Contribution limits for 2024 stand at $7,000 annually for those under age 50, with an additional $1,000 catch-up contribution permitted for those 50 and older. These limits apply across all IRA accounts combined, meaning an individual cannot contribute $7,000 to both a traditional IRA and a Roth IRA in the same year. The contribution must be divided between the two account types if both are utilized. Contributions can be made any time during the tax year or up until the tax filing deadline of the following year, typically April 15th, providing flexibility for year-end tax planning. Deductibility phases out at higher income levels for workers covered by employer retirement plans. Single filers with modified adjusted gross income above $77,000 and married couples filing jointly above $123,000 for 2024 face partial or complete loss of deduction benefits. Workers without workplace retirement plan coverage maintain full deductibility regardless of income level. This creates planning complexity for households where one spouse has workplace coverage while the other does not, requiring careful attention to income thresholds and contribution timing. Required minimum distributions begin at age 73 under current law, scheduled to increase to age 75 in 2033. The IRS calculates minimum withdrawal amounts based on account balance and life expectancy tables, with penalties of 25% applied to shortfalls, reduced to 10% if corrected promptly. These forced distributions can push retirees into higher tax brackets and trigger additional taxes on Social Security benefits, creating unintended tax consequences that require strategic planning around timing of other income sources and deductions. Early withdrawals before age 59.5 generally incur a 10% penalty plus ordinary income tax, though numerous exceptions exist. First-time home purchases up to $10,000, qualified education expenses, certain medical costs, and substantially equal periodic payments structured under IRS guidelines all avoid penalties while still owing income tax. The complexity of these exceptions and their specific requirements makes professional guidance valuable for anyone considering early access to retirement funds. Roth IRAs, established by the Taxpayer Relief Act of 1997 and named after Senator William Roth, operate under inverted tax treatment compared to traditional IRAs. Contributions receive no immediate tax deduction, entering the account with after-tax dollars. Growth accumulates tax-free rather than tax-deferred. Qualified withdrawals, those taken after age 59.5 from accounts open at least 5 years, generate no taxable income whatsoever. This structure benefits individuals expecting higher tax rates in retirement than during working years, or those seeking tax diversification across different account types. The same $7,000 annual contribution limit applies $8,000 for those 50 and older, with the total shared across traditional and Roth IRAs combined. However, Roth IRAs impose income eligibility restrictions regardless of workplace retirement plan coverage. Single filers with modified adjusted gross income above $146,000 and married couples above $230,000 for 2024 face contribution phase-outs with complete prohibition above $161,000 and $240,000, respectively. High earners often execute backdoor Roth contributions, making non-deductible traditional IRA contributions, then immediately converting to Roth, though this strategy requires careful execution to avoid pro-rata taxation issues when other traditional IRA balances exist. Roth IRAs uniquely impose no required minimum distributions during the original owner's lifetime, allowing assets to grow indefinitely if not needed for retirement expenses. This feature makes Roths particularly valuable for estate planning, as beneficiaries inherit tax-free growth potential, though they face their own distribution requirements. The 5-year rule applies separately to each conversion and requires that 5 tax years pass before earnings on conversions can be withdrawn tax-free, creating complexity for those executing multiple conversions across different years. Contributions can be withdrawn any time without taxes or penalties, since they entered with after-tax dollars. Only earnings face restrictions, accessible penalty-free after age 59.5 and 5 years of account ownership. Before meeting these requirements, earnings withdrawals trigger ordinary income tax plus a 10% penalty, though the same exceptions available for traditional IRAs apply. This contribution withdrawal flexibility gives Roths advantages over traditional IRAs for emergency access, though depleting retirement accounts for non-retirement purposes generally undermines long-term financial security. The choice between traditional and Roth contributions hinges on current versus expected future tax rates. A worker in the 12% bracket expecting to retire in the 22% bracket benefits from Roth contributions, paying lower taxes now rather than higher taxes later. Conversely, a high earner in the 35% bracket expecting retirement income in the 22% bracket gains from traditional IRA deductions. Tax rate predictions decades into the future involve considerable uncertainty, given potential legislative changes and unknown retirement income levels, suggesting that splitting contributions across both account types provides valuable diversification against tax risk. Employer-sponsored 401k plans, named after the Internal Revenue Code section authorizing them, provide workplace retirement savings with substantially higher contribution limits than IRAs. Employees can defer up to $23,000 for 2024, rising to $30,500 for those 50 and older through catch-up provisions. Employer matching contributions sit on top of these limits, with total employee and employer contributions capped at $69,000 or $76,500 for those over 50. These higher limits make 401k plans the primary retirement savings vehicle for many workers, particularly those with generous employer matches. Employer matching follows various formulas, commonly 50% of employee contributions up to 6% of salary, effectively providing a 3% of salary match. Immediate 100% matches on the first 3 or 4% of contributions represent another common structure. Some employers provide profit-sharing contributions independent of employee deferrals, depositing percentages of company profits into all eligible employee accounts. The match represents immediate guaranteed returns, making contributing at least enough to capture the full match a financial planning priority that supersedes most other investment considerations. Vesting schedules determine when employer contributions become fully owned by employees. Immediate vesting means all employer contributions belong to the employee right away. Cliff vesting grants full ownership after a specified period, often 3 years, with zero ownership until that threshold. Graded vesting phases in ownership gradually, perhaps 20% per year over 5 years. Employee contributions and their earnings always vest immediately, but employer contributions can be forfeited if employment ends before full vesting. This creates incentives for employee retention while potentially penalizing short tenure workers who change jobs frequently. Most 401k plans offer Roth 401k options alongside traditional pre-tax deferrals, providing the same after-tax contribution and tax-free qualified withdrawal structure as Roth IRAs, but without income restrictions. High earners blocked from Roth IRA contributions can access Roth treatment through workplace plans. Unlike Roth IRAs, however, Roth 401k accounts face required minimum distribution rules at age 73, though these can be avoided by rolling Roth 401k balances to Roth IRAs after leaving employment, converting employer plan RMD requirements into the more favorable IRA treatment. Loan provisions permit borrowing against 401k balances in many plans, typically up to $50,000 or 50% of the vested balance, whichever is less. Loans must be repaid with interest within 5 years for general purpose loans or longer for primary residence purchases. While loans avoid early withdrawal penalties and taxes as long as repayment continues, they remove funds from investment growth potential during the loan period and must be repaid in full if employment terminates or face classification as taxable distributions subject to penalties. The availability creates useful flexibility, but should be considered carefully against alternatives like home equity lines or personal loans. Similar structures exist for other employment sectors. 403b. Plans serve employees of public schools, certain non-profits, and religious organizations. These function nearly identically to 401k plans with the same contribution limits and general rules, though investment options historically skewed toward annuities rather than mutual funds, a distinction that has blurred considerably as modern 403b plans increasingly resemble their 401k counterparts. Special catch-up contribution rules for employees with 15+ years of service can add an extra $3,000 annually, beyond the standard age 50 catch-up provision. 457 plans serve state and local government employees, plus some non-profit workers. Contribution limits match 401k plans at $23,000 with catch-up provisions, but withdrawals face no 10% early withdrawal penalty regardless of age, a significant advantage for those planning early retirement or career changes. However, 457 plans do not permit loans in most cases, and contributions to governmental 457 plans remain subject to creditor claims, unlike ERISA-protected 401k and 403b plans. Some fortunate employees have access to both 403b and 457 plans, allowing contributions to both up to the maximum in each, effectively doubling tax-advantaged retirement savings capacity compared to workers with only one plan type available. Taxable brokerage accounts stand apart from retirement accounts entirely. They impose no contribution limits, accepting deposits of any size at any time from any legal income source. No withdrawal restrictions apply, with full access to funds without penalties or age requirements. No required distributions force sales at particular ages. This complete flexibility makes taxable accounts essential for goals shorter than retirement timelines, major purchases within 5 to 10 years, or wealth accumulation beyond retirement account capacity. The tax treatment, while less favorable than retirement accounts, offers its own advantages. Dividends and interest face annual taxation at ordinary income or qualified dividend rates depending on type. Capital gains remain unrealized and untaxed until securities are sold, allowing tax deferral through indefinite holding. Long-term capital gains on assets held over 1 year receive preferential rates of 0, 15, or 20% based on income, substantially below ordinary income tax rates reaching 37%. Short-term gains on assets held 1 year or less face ordinary income rates, creating strong incentives for patience. Tax loss harvesting provides opportunities to offset gains by strategically selling depreciated positions to realize losses. These losses offset capital gains, dollar for dollar, with up to $3,000 of excess losses deductible against ordinary income annually an unlimited carry forward of remaining losses to future years. This technique generates tax benefits impossible in retirement accounts, where gains and losses have no tax consequences. Wash sale rules prohibit repurchasing substantially identical securities within 30 days before or after the sale, requiring careful execution to maintain desired investment exposure while harvesting losses. Perhaps most significantly, taxable account assets receive a step up in cost basis at death, eliminating capital gains taxes on appreciation during the deceased owner's lifetime. Beneficiaries inherit securities at their date of death value rather than original purchase price, allowing immediate sale without capital gains consequences. This treatment makes taxable accounts remarkably efficient for wealth transfer, potentially superior to retirement accounts, which trigger income taxation for most beneficiaries. The combination of flexibility during life and favorable estate treatment at death makes taxable brokerage accounts indispensable, despite their less favorable tax treatment compared to retirement accounts. 529 education savings plans address college and K-12 private school tuition costs through state-sponsored investment programs. Contributions receive no federal tax deduction, but grow tax-free and withdraw tax-free when used for qualified education expenses. Many states offer residents income tax deductions or credits for contributions to their home state plans, though investment options and fees vary considerably across states. Contributors can generally select any state's plan regardless of residency, making comparison shopping valuable, though foregoing home state tax benefits requires careful analysis. Contribution limits are substantial, often $300,000 to $500,000 per beneficiary, depending on the state, though these represent lifetime aggregate limits across all contributors rather than annual restrictions. 5-year gift tax averaging allows front-loading up to $85,000, 5 times the annual gift tax exclusion of $17,000 for 2024, without triggering gift tax consequences, though no additional gifts to that beneficiary can occur during the 5-year period. Married couples can jointly contribute $170,000 using this superfunding strategy, rapidly building education savings while removing assets from taxable estates. Qualified expenses include tuition, fees, books, supplies, required equipment, and room and board for students enrolled at least half-time. Recent expansions permit up to $10,000 annually for K-12 tuition at public, private, or religious schools, and up to $10,000 of student loan repayment over the account beneficiary's lifetime. The 2024 Secure 2.0 Act added provisions allowing up to $35,000 of unused 529 assets to be rolled tax-free to the beneficiary's Roth IRA after 15 years, subject to annual Roth contribution limits, providing a valuable safety valve for overfunded accounts. Non-qualified withdrawals trigger ordinary income tax plus a 10% penalty on earnings, though contributions return tax-free since they were made with after-tax dollars. Beneficiary changes to qualified family members, siblings, first cousins, parents or children avoid this penalty, allowing accounts to be redirected if the original beneficiary receives scholarships or chooses not to pursue higher education. This flexibility makes 529 plans valuable for families with multiple children across different ages, allowing reallocation as education paths become clearer. Health savings accounts, though designed primarily for medical expenses, function as remarkably powerful retirement savings vehicles for those eligible. Qualification requires enrollment in a high-deductible health plan, defined for 2024 as a health insurance plan with minimum deductibles of $1,600 for individual coverage or $3,200 for family coverage. Contribution limits reach $4,150 for individuals and $8,300 for families, with an additional $1,000 catch-up contribution for those 55 and older. These contributions reduce taxable income identically to traditional IRA contributions. The triple tax advantage distinguishes HSAs from other account types. Contributions receive immediate tax deductions. Growth accumulates tax-free. Withdrawals for qualified medical expenses at any age generate no taxation whatsoever. No other account type combines all three benefits. This makes HSAs theoretically superior to both traditional and Roth IRAs for savers with sufficient cash flow to cover current medical expenses out of pocket while allowing HSA balances to grow for future use. Qualified medical expenses encompass a broad range, including insurance deductibles and co-pays, prescription drugs, dental and vision care, some over-the-counter medications, and various treatments and medical equipment defined in IRS Publication 502. Notably, expenses need not be incurred in the same year as reimbursement. Investors can pay medical costs from other funds, save receipts indefinitely, and withdraw from HSAs years or decades later for those documented expenses. This allows HSAs to grow untouched for years while building a reservoir of reimbursable expenses that can be claimed whenever desired. After age 65, HSAs function like traditional IRAs for non-medical withdrawals, avoiding the 20% penalty that applies to non-qualified withdrawals before 65 while still owing ordinary income tax. This flexibility means HSAs can serve as additional retirement accounts for general expenses once Medicare and other coverage reduce out-of-pocket medical needs. Combined with tax-free medical expense withdrawals at any age, HSAs provide more versatility than traditional retirement accounts. For eligible individuals maximizing contributions while letting balances grow, HSAs arguably represent the single most tax-efficient savings vehicle available. Custodial accounts under the Uniform Gifts to Minors Act and Uniform Transfers to Minors Act allow adults to transfer assets to children while maintaining control until the child reaches majority age. UGMA accounts accept cash and securities, while UTMA accounts additionally permit real estate and other property types. These accounts require no earned income from the minor, unlike Roth IRAs for children, making them accessible for any child regardless of work history. No contribution limits exist, though annual gifts exceeding $17,000 for 2024 may trigger gift tax filing requirements and count against lifetime estate and gift tax exemptions. Assets transferred to custodial accounts become irrevocable gifts, legally owned by the minor immediately, even though the custodian controls the account. This means assets count as the child's for financial aid purposes, potentially reducing college financial aid eligibility by up to 20% of the account value compared to parent-owned 529 accounts assessed at much lower rates. The kiddie tax applies to unearned income, taxing the first $300 at the child's rate, typically $0 for children with no other income, the next are $3,300 at the child's rate, and amounts above $2,600 at the parent's marginal rate. Control transfers to the child at age of majority, 18 or 21 depending on state law, at which point the now adult child can use funds for any purpose, regardless of the original donor's intentions. This lack of control creates risk that carefully saved education funds might be spent on less productive purposes, a common concern that leads many families to prefer 529 plans, despite their limitations to education expenses. Once given, the transfer cannot be reversed, making custodial accounts less flexible than alternatives where parents retain ultimate control. Together, these account types demonstrate the range of tax-advantaged and taxable structures available, each optimized for specific purposes and offering distinct advantages and constraints. Markets themselves are divided into various structures and mechanisms that facilitate capital formation and trading across different asset types. Financial markets operate under organizational principles distinct from individual account structures, though both ultimately serve capital allocation functions. The mechanisms governing how securities are issued, priced, and exchanged introduce their own complexities beyond simple buy and hold investing. Understanding market structure helps explain why certain investments trade more efficiently than others, how prices are discovered, and where liquidity originates. Markets divide fundamentally into primary and secondary categories based on their function within the capital formation process. Primary markets facilitate new security issuance, channels through which corporations and governments raise capital by selling stocks or bonds directly to investors. When a company conducts an initial public offering, it operates in the primary market, receiving proceeds from share sales that fund business operations or expansion. When the Treasury Department auctions new government bonds, it similarly raises funds through primary market transactions. These activities create securities, bringing new investment opportunities into existence. Secondary markets, by contrast, provide venues where existing securities change hands between investors without affecting the issuing entity. When an investor purchases shares of an established public company through a brokerage account, that transaction occurs in the secondary market. The company receives no funds from this exchange. The seller gets cash, the buyer gets shares, and the company remains entirely uninvolved. This distinction matters because secondary market liquidity enables primary market issuance. Investors purchase new offerings partly because they know secondary markets allow eventual exit at fair prices. Without liquid secondary markets, primary market capital raising would prove far more difficult and expensive. Exchange-traded securities and over-the-counter instruments represent another fundamental division. Exchanges like the New York Stock Exchange or Nasdaq provide centralized, regulated platforms with standardized rules, transparent pricing, and guaranteed settlement. Securities listed on exchanges meet specific disclosure and governance requirements. Trading occurs through regulated broker-dealers with established clearing mechanisms ensuring transaction completion. This infrastructure creates reliable liquidity and price discovery, advantages that make exchange listing desirable despite associated costs and regulatory burdens. Over-the-counter markets operate differently, facilitating direct trades between parties without centralized exchange infrastructure. Many corporate bonds, for instance, trade OTC through dealer networks rather than on organized exchanges. Dealers maintain inventories of bonds, quoting prices at which they will buy or sell. Investors contact dealers to execute trades, with pricing negotiated based on current market conditions, rather than displayed on public order books. This decentralized structure often results in wider bid-ask spreads and less transparent pricing compared to exchange-traded securities, though it accommodates securities too diverse or thinly traded for efficient exchange listing. Market makers provide essential liquidity by continuously offering to buy and sell securities at quoted prices. These specialized firms profit from bid-ask spreads, the difference between prices at which they purchase and sell. In exchange for this profit opportunity, they maintain orderly markets by standing ready to take the opposite side of trades, even when natural buyer-seller matches do not immediately exist. Without market makers, liquidity would depend entirely on finding counterparties with precisely opposite intentions, a matching process that would dramatically reduce trading efficiency and increase price volatility. Market efficiency describes how completely security prices reflect available information. The efficient market hypothesis posits three forms. Weak form efficiency suggests that past prices provide no predictive value for future movements, rendering technical analysis ineffective. Semi-strong form efficiency claims that all publicly available information immediately incorporates into prices, making fundamental analysis of public data unrewarding. Strong form efficiency argues that even private information already reflects in prices, though insider trading laws and enforcement evidence contradicts this strongest claim. Reality likely falls somewhere between weak and semi-strong efficiency, with debate continuing about exactly where. Trading hours vary globally, with major exchanges typically operating during local business hours. US markets trade from 9:30 a.m. to 4 p.m. Eastern Time on business days, with pre-market and after-hours sessions extending availability, but with reduced liquidity and wider spreads. International markets operate on their own schedules, creating a continuous trading cycle as markets open sequentially across time zones. This global interconnection means overnight developments in Asian or European markets influence US opening prices, and vice versa, creating a 24-hour information flow, even though individual exchanges maintain defined hours. These market structures, primary and secondary, exchange and OTC, apply broadly across asset types, though specific implementations vary. Stock markets, the most visible component of public capital markets, demonstrate these organizational principles through exchanges operating across major financial centers. Stock markets consist of interconnected exchange networks and electronic trading systems, where equity ownership in publicly traded corporations changes hands continuously during market hours. The infrastructure supporting these transactions has evolved considerably from the physical trading floors, where brokers once shouted orders across crowded rooms. Modern equity markets operate primarily through electronic matching systems, though the organizational frameworks and regulatory structures established during earlier eras remain largely intact. The New York Stock Exchange, founded in 1792 under a buttonwood tree on Wall Street, represents the world's largest stock exchange by market capitalization of listed companies. As of recent measurements, NYSE-listed firms account for roughly $25 trillion in total market value, approximately 40% of global equity market capitalization. The exchange maintains listing standards requiring minimum market values, share prices, and shareholder counts, creating a selective environment where only established companies typically qualify. Trading occurs through a hybrid system, combining electronic matching with designated market makers who maintain orderly markets in assigned securities, a remnant of traditional floor trading adapted for modern technology. Nasdaq, established in 1971 as the first electronic stock market, operates entirely through computerized trading without a physical floor. Its market capitalization exceeds $20 trillion, concentrated heavily in technology and growth companies. The exchange maintains multiple listing tiers: Global Select Market, Global Market, and Capital Market, each with progressively less stringent requirements. This structure accommodates companies across developmental stages from early growth to established blue chips. Average daily trading volume often surpasses that of the NYSE, despite having fewer listed companies, reflecting the active trading typical in technology and growth stocks that dominate Nasdaq composition. Regional exchanges including Cboe BZX, NYSE American, and IEX provide additional liquidity and competition. Though combined, they represent small fractions of total US equity volume. These venues often specialize in particular security types or attract specific trader preferences, such as EX's speed bump, designed to reduce high-frequency trading advantages. The fragmentation across multiple venues creates complexity in order routing and execution, but generally benefits investors through competitive pressure on trading costs and technological innovation. Market indices track subsets of stocks to provide benchmarks for performance measurement and investment strategy. The S&P 500, comprising approximately 500 large-cap US companies, selected by a committee based on market size, liquidity, and sector representation, serves as the primary US equity market benchmark. The index weights members by market capitalization, meaning larger companies exert proportionally greater influence on index movements. This makes the S&P 500 a float-adjusted market cap-weighted index that effectively measures the performance of investable large-cap US equities. Index funds and ETFs tracking the S&P 500 hold trillions of dollars, making it arguably the most important single benchmark in global finance. The Dow Jones Industrial Average, dating to 1896, includes just 30 large companies selected by editors at S&P Dow Jones Indices. Unlike the S&P 500, the Dow weights members by share price rather than market capitalization, creating the unusual result that higher-priced stocks influence the index more than larger companies with lower per-share prices. This methodology, a legacy of calculation methods predating electronic computing, persists despite its analytical limitations. The Dow's small membership and price weighting make it less representative than the S&P 500, though its long history and name recognition maintain its prominence in financial media. The Nasdaq Composite includes all stocks listed on the Nasdaq exchange, over 3,000 securities in total, heavily weighted toward technology companies. The Russell 2000 tracks small-cap stocks defined as companies ranked 1 through 3,000 by market capitalization among US equities. International indices like the FTSE 100 in London, DAX in Germany, and Nikkei 225 in Japan serve similar benchmarking functions for their respective markets. These indices enable performance comparisons across geographies and provide targets for index funds seeking international exposure. Stock ownership comes in two primary forms, though common stock dominates public market trading. Common stock represents residual ownership in corporations, with shareholders entitled to vote on major decisions and board elections. One share typically equals one vote, though some companies issue multiple share classes with different voting rights, allowing founders or insiders to maintain control while raising public capital. Common stockholders receive dividends if the board declares them but hold no guarantee of payment. In liquidation scenarios, common shareholders stand last in line after all creditors and preferred shareholders, receiving whatever value remains, which often equals zero in bankruptcy situations. Preferred stock occupies a hybrid position between common equity and bonds. Preferred shares typically pay fixed dividends similar to bond interest, though companies can suspend payments during financial stress without triggering default. Preferred shareholders generally lack voting rights, but receive priority over common shareholders for both dividend payments and liquidation proceeds. The combination of limited upside, fixed income characteristics, and dividend preferential treatment makes preferred stocks behave more like bonds than equities in most circumstances. Trading volume remains much lower than common stocks, with institutional investors like insurance companies comprising most buyers seeking stable income streams. Market capitalization categorizes companies by total stock value, calculated as share price multiplied by shares outstanding. Large-cap stocks exceed $10 billion in market value, encompassing the established corporations that dominate index weightings. Mid-cap stocks range from approximately $2 to $10 billion, often representing successful companies still growing toward large-cap status. Small-cap stocks fall between $300 million and $2 billion, typically younger companies or those serving narrow market niches. Micro-cap stocks below $300 million trade thinly with substantial volatility and often limited financial information. Historical data shows small-cap stocks outperforming large caps over very long periods, though with considerably higher volatility and occasional extended stretches of underperformance. Growth stocks characterize companies reinvesting earnings into expansion rather than paying dividends, typically trading at high valuations relative to current earnings in anticipation of future profit growth. Technology companies often fit this profile, with investors accepting minimal or zero current income in exchange for potential capital appreciation. Value stocks, by contrast, trade at low valuations relative to earnings, book value, or other fundamental metrics, often representing mature companies in stable industries paying substantial dividends. The growth versus value distinction creates different risk-return profiles, with growth stocks performing better during economic expansions and low interest rate environments, while value stocks typically outperform during early recovery phases and when rates rise. The Global Industry Classification Standard divides companies into 11 sectors: energy, materials, industrials, consumer discretionary, consumer staples, healthcare, financials, information technology, communication services, utilities, and real estate. Sector allocation decisions significantly affect portfolio characteristics and returns. Technology and financial stocks each comprise roughly 12 to 15% of S&P 500 weight as of recent measurements, while utilities and materials each represent 2 to 3%. Sector weightings shift over time as company valuations and compositions change, with technology growing substantially over past decades while previously dominant sectors like telecommunications diminished. Trading mechanisms have evolved substantially, but fundamentally involve matching buyers and sellers at agreed prices. Market orders execute immediately at the best available current price, guaranteeing execution but not price. A market order to buy 100 shares fills at whatever price sellers currently offer, which might differ considerably from the last trade price if the stock moved quickly or liquidity is limited. This certainty of execution, paired with price uncertainty, makes market orders suitable for liquid securities when immediate execution matters more than capturing specific prices. Limit orders specify maximum purchase prices or minimum sale prices, executing only when the market reaches those levels. A limit order to buy at $50 fills only if the stock trades at $50 or less, potentially never executing if prices remain above that threshold. Limit orders provide price certainty but execution uncertainty, the inverse of market orders. Day limit orders expire at market close if unfilled, while good till cancelled orders remain active until executed or manually cancelled, sometimes for weeks or months. Stop orders trigger market orders once prices reach specified levels, commonly used to limit losses or protect profits. A stop-loss order to sell at $45 on a stock currently trading at $50 converts to a market sell order if the price falls to $45, though actual execution might occur below that level if prices decline rapidly. Stop-limit orders combine stop and limit characteristics, triggering limit orders at specified prices rather than market orders, providing more price control but risking non-execution during fast markets. Bid-ask spreads represent the gap between highest buy orders and lowest sell orders at any moment. A stock with a $50 bid and $50 ask has a 5 cent or 0.1% spread, minimal for liquid large-cap stocks. Less liquid securities might show spreads of 25 cents or more, representing meaningful transaction costs. Market makers profit from these spreads by buying at bid prices and selling at ask prices, earning the difference thousands of times daily across numerous securities. Narrow spreads indicate liquid markets with low trading costs, while wide spreads signal illiquidity and higher costs. High-frequency trading firms use sophisticated technology to execute thousands of trades in microseconds, capturing tiny profits on minimal price movements aggregated across enormous volume. These operations account for substantial percentages of total daily volume, perhaps 50% or more by some estimates, generating controversy about market fairness and stability. Proponents argue high-frequency traders provide liquidity and narrow spreads, benefiting all investors. Critics contend they exploit speed advantages unavailable to ordinary investors and contribute to volatility through rapid position changes. Circuit breakers halt trading during extreme volatility to prevent panic selling and allow information dissemination. A 7% S&P 500 decline before 3:25 p.m. triggers a 15-minute trading halt. A 13% decline before 3:25 p.m. causes another 15-minute halt. A 20% decline at any time stops trading for the day. Individual stocks face limit up, limit down rules, preventing trades outside specified percentage bands from reference prices, typically 5 or 10%, depending on security and time. These mechanisms, implemented after the 1987 crash and refined following the 2010 flash crash, aim to reduce extreme short-term movements while allowing legitimate price discovery. Initial public offerings bring private companies to public markets through primary market transactions. Companies hire investment banks as underwriters to manage the process, conducting due diligence, preparing regulatory filings, and marketing shares to potential buyers. The underwriting syndicate prices shares based on company financials, growth prospects, market conditions, and investor demand gauged through roadshow presentations to institutional investors. Pricing balances company desires for maximum capital, raised against investor demands for attractive entry valuations likely to produce first-day gains. Lock-up periods, typically 90 to 180 days post-IPO, prevent company insiders and pre-IPO investors from selling shares, supporting price stability during initial public trading. Lock-up expirations often create selling pressure as previously restricted shares become tradable, sometimes causing notable price declines. Recent high-profile IPOs, including Airbnb in December 2020 priced at $68 and opened at $146, while others like Uber in May 2019 priced at $45 but declined below $40 in early trading, illustrating the range of possible outcomes influenced by market conditions and company-specific factors. Fundamental analysis attempts to determine intrinsic stock values through examining financial statements, management quality, competitive positioning, and growth prospects. The price-to-earnings ratio, calculated as share price divided by annual earnings per share, provides a simple valuation metric. Historical averages for the S&P 500 center around 15 to 16, though valuations fluctuate with interest rates, growth expectations, and market sentiment. Individual stocks range from single-digit PIE ratios for struggling companies or slow-growth industries to triple-digit multiples for high-growth technology firms, expected to dramatically expand earnings. Dividend yield expresses annual dividends as a percentage of stock price, calculated by dividing annual dividend per share by share price. A $100 stock paying $3 annually yields 3%. Yields vary across sectors, with utilities, and consumer staples typically yielding 3 to 5%, while technology growth stocks often yield 0 or under 1%. Price-to-book ratio compares market value to accounting book value, net assets minus liabilities as reported on balance sheets. Ratios above 1 indicate markets value companies higher than accounting net worth, normal for profitable businesses, while ratios below 1 might signal financial distress or hidden value depending on circumstances. Together, stock market structures, indices, trading systems, and valuation approaches provide the framework for equity investing in publicly traded companies. Bond markets, though less visible to individual investors, comprise an even larger segment of global capital markets, operating through dealer networks and over-the-counter mechanisms rather than centralized exchanges. Fixed income securities provide capital formation mechanisms for governments and corporations while offering investors relatively predictable income streams and lower volatility compared to equities. The bond market, measured by outstanding debt value, exceeds $50 trillion globally, surpassing equity market capitalization despite receiving less media attention and retail investor participation. This disparity reflects bonds' traditional role as institutional investment vehicles, though individual investors increasingly access fixed income through mutual funds, ETFs, and direct Treasury purchases. US Treasury securities anchor global fixed income markets, serving as the risk-free benchmark against which all other bonds are measured. The US government's taxing authority and currency printing capacity theoretically eliminate default risk, making Treasury yields the baseline return for lending without credit concerns. Treasuries divide into three categories by maturity. Treasury bills mature in 4, 8, 13 or 26 weeks, selling at discounts to face value and paying no periodic interest. Treasury notes mature in 2, 3, 5, 7 or 10 years, paying interest semi-annually. Treasury bonds extend to 20 or 30-year maturities, also paying semi-annual interest. As of recent market conditions, yields range from approximately 4.5 to 5% on short-term bills to 4.5 to 4.8% on long-term bonds, with the exact structure depending on Federal Reserve policy and economic expectations. The Treasury yield curve graphs these rates across maturities, typically sloping upward, as longer terms command higher yields to compensate for extended interest rate risk and inflation uncertainty. Normal upward sloping curves reflect healthy economic expectations. Flat curves, where short and long rates converge, often signal economic uncertainty or monetary policy transitions. Inverted curves with short rates exceeding long rates have historically preceded recessions, as bond markets anticipate Federal Reserve rate cuts in response to economic weakness. The curve's shape provides valuable information about market expectations for growth, inflation, and monetary policy, making it closely watched by investors and policymakers. Treasury inflation-protected securities, or TIPS, adjust principal values based on consumer price index changes, protecting purchasing power during inflationary periods. TIPS pay fixed interest rates applied to adjusted principal, meaning both interest payments and eventual maturity values rise with inflation. During deflation, principal cannot fall below original par value, providing downside protection. Current TIPS yields, the real return above inflation, range from approximately 1.5 to 2.5%, depending on maturity. Investors comparing TIPS and nominal Treasury yields can infer market inflation expectations, as the difference between them, the break-even inflation rate, represents the inflation level at which both investments produce equivalent returns. I-bonds, savings bonds adjusted for inflation, offer similar protection with different mechanics. These non-marketable securities, purchased directly from Treasury Direct, combine fixed rates set at issuance with variable rates adjusting semi-annually based on CPI changes. Purchase limits of $10,000 per person annually plus $5,000 via tax refunds restrict their use for large portfolios, but they serve effectively for emergency funds and conservative savers seeking inflation protection with no market price volatility. Redemption restrictions preventing sales during the first year and imposing 3-month interest penalties before 5 years limit liquidity compared to marketable TIPS. Agency bonds issued by government-sponsored enterprises like Fannie Mae, Freddie Mac, and the Federal Home Loan Banks carry implicit, though not explicit, government backing, resulting in yields slightly above Treasuries. These spreads typically range from 10 to 50 basis points, depending on maturity and market conditions, compensating investors for marginally higher credit risk despite the entity's quasi-governmental status and presumed government support during financial stress. Corporate bonds enable companies to raise capital through debt rather than equity issuance, preserving existing shareholder control while accepting fixed obligations. Credit quality determines pricing, with rating agencies Moody's, Standard & Poor's, and Fitch assessing default probability and assigning letter grades. Investment-grade bonds, rated BBB- or higher by S&P and Fitch or Ba3 or higher by Moody's, represent companies with solid financials and low default risk. High-yield bonds, commonly called junk bonds, fall below investment grade, carrying BBB+ or lower ratings and substantially higher default risk. Credit spreads, the yield difference between corporate bonds and comparable maturity treasuries, quantify this default risk compensation. Investment-grade corporate bonds currently trade at spreads ranging from roughly 50 basis points for AIA-rated debt to 150 to 200 basis points for BBB-rated issues, the lowest investment-grade category. High-yield spreads exceed 300 basis points and can reach 500 to 1,000 basis points or more for distressed companies facing near-term default possibilities. These spreads widen during economic stress as default fears intensify and narrow during expansions when corporate health improves. Historical default rates vary dramatically by rating category. A and AA rated bonds default extremely rarely, perhaps 0.01 to 0.1% annually over long periods. A rated bonds default at roughly 0.1 to 0.3% annual rates. BBB bonds, the lowest investment grade, show 0.2 to 0.5% default frequencies. High-yield bonds default at 2 to 4% annually on average, with rates spiking above 10% during recessions. These statistics explain spread differences as investors demand compensation proportional to expected losses from defaults. Corporate bond indices track aggregate fixed income performance. The Bloomberg US Corporate Investment Grade Bond Index includes investment-grade corporate debt with at least 1 year to maturity. The ICE BOFA US High Yield Index covers below investment-grade domestic corporate bonds. These benchmarks enable performance comparison and serve as targets for bond mutual funds and ETFs seeking specific credit quality exposure. Callable bonds grant issuers rights to redeem debt before maturity, typically exercised when interest rates fall, and companies can refinance at lower costs. Call provisions benefit issuers, but disadvantage bondholders who face reinvestment at prevailing lower rates after calls. Callable bonds yield more than non-callable equivalents, compensating investors for this reinvestment risk. Call protection periods prohibit early redemption for specified terms, often 5 to 10 years after issuance, providing temporary security before call risk activates. Convertible bonds allow holders to exchange debt for predetermined amounts of company stock, usually at prices above current market levels at issuance. These hybrid securities provide bond downside protection with equity upside participation if stock prices rise sufficiently to make conversion attractive. Convertibles yield less than straight corporate bonds from the same issuer, as investors accept lower income in exchange for equity option value. Technology and growth companies frequently issue convertibles, accessing capital at lower rates than straight debt, while potentially settling obligations through equity conversion rather than cash repayment. Municipal bonds, debt issued by state and local governments, plus their agencies and authorities, finance infrastructure projects, schools, hospitals, and general governmental operations. The defining characteristic distinguishing municipals from corporate and treasury bonds is federal tax exemption on interest income, a subsidy designed to reduce borrowing costs for public entities. This exemption makes municipals particularly attractive to high-income investors facing top marginal tax rates, while lower bracket investors often achieve superior after-tax returns from taxable bonds yielding more nominally. Tax equivalent yield calculations compare municipal and taxable bond returns. The formula divides municipal yield by 1 minus the marginal tax rate. A 3% municipal bond equals a 4.69% taxable bond for an investor in the 36% marginal bracket, calculated as 3% divided by 0.64. The higher the tax bracket, the more valuable municipal tax exemption becomes, potentially making lower-yielding municipals superior to higher-yielding taxable alternatives on an after-tax basis. State tax exemptions for in-state municipal bonds add value for residents of high-tax states like California, New York, and New Jersey, potentially providing both federal and state tax-free income. Municipal bonds divide into two primary categories. General obligation bonds carry full faith and credit backing of issuing governments, secured by taxing authority. These bonds typically offer lower yields given relatively strong security, particularly for financially sound states and municipalities. Revenue bonds, by contrast, are secured only by specific project revenues, such as toll road receipts, utility fees, or hospital income. Revenue bonds yield more than general obligation bonds from the same issuer, reflecting their narrower security and higher risk if projects underperform revenue projections. Credit quality varies substantially across municipal issuers. Many municipalities maintain AA or AAA ratings comparable to highly rated corporations, while others receive BBB or lower grades, reflecting fiscal challenges. Detroit's 2013 bankruptcy, the largest municipal bankruptcy in U.S. history, resulted in significant bondholder losses, demonstrating that municipal bonds carry real default risk despite their generally strong record. Puerto Rico's debt crisis and ultimate restructuring in the 2020s provided another prominent example of municipal credit challenges affecting investors. The alternative minimum tax complicates municipal bond taxation for some investors. Certain private activity bonds financing projects, like airports or stadiums, with substantial private use, generate income subject to AMT despite federal tax exemption under regular taxation. Investors subject to AMT must consider whether municipal bonds they purchase create AMT liability, potentially eroding or eliminating tax advantages. This complexity makes professional tax guidance valuable for high-income investors navigating municipal bond selection. Bond pricing mechanics apply universally across government, corporate, and municipal sectors. Prices move inversely to yields, rising when rates fall and declining when rates rise. Duration quantifies this sensitivity, with longer duration bonds exhibiting greater price volatility. Credit spread widening reduces bond values, even if underlying Treasury yields remain constant, a particular concern during economic stress when investors flee lower quality debt for safer alternatives. Beyond traditional stocks and bonds, alternative investments occupy specialized roles in diversified portfolios, offering characteristics distinct from conventional asset classes. Alternative investments represent asset classes where traditional equities meet non-traditional strategies, creating vehicles with risk-return profiles distinct from stocks and bonds. These investments typically exhibit lower correlation with conventional markets, potentially reducing overall portfolio volatility when combined with traditional holdings. However, they often carry higher fees, limited liquidity, and greater complexity, requiring careful evaluation before inclusion in portfolios. Real estate investment trusts, or REITs, provide exposure to property investments through publicly traded securities. These companies own and operate income-producing real estate across sectors including apartments, office buildings, shopping centres, warehouses, and specialised properties like cell towers or data centres. Federal tax law requires REITs to distribute at least 90% of taxable income to shareholders as dividends, resulting in yields typically ranging from 3 to 5%, substantially above most stock dividends. REIT share prices fluctuate with both property market conditions and equity market sentiment, creating exposure to real estate returns without the complications of direct property ownership like maintenance, tenant management, and illiquidity. Commodities encompass physical goods, including precious metals, energy products, agricultural crops, and industrial materials. Direct commodity ownership proves impractical for most investors, but commodity futures contracts and commodity-focused mutual funds, or ETFs, provide accessible exposure. Gold traditionally serves as an inflation hedge and safe haven asset during market stress, though its long-term returns barely match inflation with substantial volatility. Energy commodities like crude oil move with global economic activity and geopolitical developments. Agricultural commodities respond to weather patterns, crop yields, and demand shifts. Historical evidence shows commodity returns correlating weakly with stocks and bonds, providing diversification benefits, though with considerable price volatility and no inherent return expectations beyond supply-demand dynamics. Private equity and venture capital investments involve purchasing ownership stakes in companies not publicly traded. Private equity firms typically buy mature businesses, restructure operations, and exit after several years through sales or public offerings. Venture capital funds invest in early-stage companies seeking growth capital, accepting high failure rates for occasional massive successes. Minimum investments usually begin at $250,000 or more, restricting access to accredited investors meeting income or net worth thresholds. Liquidity remains extremely limited, with capital typically locked up for 7 to 10 years. Fee structures follow 2 and 20 conventions, meaning 2% annual management fees plus 20% of profits above specified return hurdles, substantially exceeding public market fund fees. Hedge funds employ diverse strategies including long-short equity, global macro, event-driven, and relative value approaches, seeking positive returns regardless of market direction. Similar to private equity, hedge funds restrict access to accredited investors and charge hefty fees following 2 and 20 structures. Liquidity varies but often involves quarterly redemption windows with advance notice requirements. Performance evidence suggests most hedge funds underperform simple stock bond portfolios after accounting for fees, though top-performing funds can deliver exceptional results. Cryptocurrencies like Bitcoin and Ethereum represent digital assets operating on blockchain technology. Extreme volatility, limited history, regulatory uncertainty, and unclear intrinsic value make cryptocurrencies highly speculative. Some investors allocate small percentages, seeking asymmetric returns, accepting that positions might become worthless but could appreciate substantially if adoption expands. Alternative investments serve vital diversification functions for portfolios seeking to reduce dependence on traditional stock and bond performance, offering potential protection during conventional market stress. The reduced correlation with standard asset classes provides the primary appeal, as alternatives may hold value or even appreciate when stocks and bonds decline simultaneously. This protection arrives at considerable cost through higher fees, limited liquidity, and substantial complexity in evaluation and monitoring. It's a delicate, fee-intensive balancing act in an asset category defined by constant performance dispersion and limited transparency. Imagine reviewing your investment portfolio during a routine afternoon when suddenly values plunge 20% in days. This scenario, far from hypothetical, materializes periodically throughout market history when volatility surges and investor psychology shifts dramatically. Market volatility episodes punctuate investment history with sufficient regularity to demand understanding rather than surprise. October 19th, 1987, Black Monday, witnessed the Dow Jones Industrial Average plunge 22.6% in a single trading session, the largest one-day percentage decline on record. The crash erased roughly $500 billion in market value, equivalent to multiple trillion dollars in current terms, triggering panic selling as automated trading programs amplified downward momentum. No single clear catalyst explained the severity, with factors including program trading, portfolio insurance strategies, and international market contagion combining to produce extraordinary losses. If not exactly common, declines of this magnitude remain part of the Hague investing experience that recurs periodically across generations. The technology bubble burst between 2000 and 2002, eliminated approximately 78% of the Nasdaq Composite Index's value as internet and telecommunication stocks collapsed from unsustainable valuations. Companies with no profits or even revenues traded at billion-dollar market capitalizations based purely on growth projections that proved wildly optimistic. When sentiment shifted and investors demanded actual profitability, share prices evaporated with a remarkable speed. The S&P 500 fell roughly 49% peak to trough over 31 months, an extended decline causing substantial wealth destruction, particularly concentrated in technology-heavy portfolios. The financial crisis of 2008 brought the most severe market decline since the Great Depression. The S&P 500 fell 57% from its October 2007 peak to its March 2009 trough, with particularly acute drops during September and October 2008, following Lehman Brothers bankruptcy and the subsequent credit market freeze. Daily swings of 5 to 10%, movements that typically occur once every few years, happened multiple times weekly during the crisis peak. Investors who sold near the bottom locked in devastating losses, while those who maintained positions through the turmoil eventually recovered and prospered as markets rebounded strongly from 2009 onward. The VIX index, often called the fear gauge, quantifies expected stock market volatility derived from S&P 500 option prices. Normal VIX levels range from 12 to 20, indicating relatively calm markets. Readings above 30 signal elevated anxiety, while spikes above 40 or 50 indicate extreme fear and potential panic. The VIX exceeded 80 during both the 2008 crisis and the March 2020 COVID-19 market crash, the highest levels in its history. These episodes, while temporary in retrospect, felt permanent to investors experiencing them, triggering emotional responses that often led to poor decisions. Causes of volatility include unexpected economic data, geopolitical events, corporate earnings disappointments, central bank policy shifts, and changes in investor sentiment. Sometimes sharp declines reflect genuine deterioration in economic fundamentals. Other times, they represent psychological overreactions to uncertainty, with prices falling beyond levels justified by changed circumstances. Distinguishing between rational repricing and emotional overreaction proves extraordinarily difficult in real time when information remains incomplete and fear dominates rational analysis. Investment portfolios are not static. They change in value due to countless influences ranging from corporate earnings and economic data to investor psychology and herd behavior. The mass movement toward or away from particular investments based on collective sentiment rather than individual analysis. Assessment of portfolio structure begins with identifying how capital distributes across major asset categories and understanding the relationship between this allocation and expected outcomes. Two core concepts, asset allocation strategy and diversification methodology, form the foundation of this analysis. Research examining portfolio performance across decades reveals that asset allocation decisions account for more than 90% of return variability over time, a finding from studies conducted by Brinson, Hood, and Biebauer during the 1980s, and subsequently validated through additional analysis. Security selection within asset classes and market timing decisions, despite consuming most investor attention and effort, contribute relatively little to long-term results by comparison. This counterintuitive conclusion suggests that the broad portfolio framework matters far more than individual investment choices within that framework. An investor holding a 70% stock, 30% bond portfolio will experience returns and volatility closely tracking that allocation, regardless of which specific stocks or bonds are selected, assuming reasonable diversification within each category. Switching to an 80-20 or 60-40 allocation changes expected outcomes far more dramatically than replacing one stock with another or attempting to time market entries and exits. Strategic asset allocation establishes baseline portfolio structure intended to remain relatively stable over extended periods, adjusted only for major life changes or shifts in financial goals. A 40-year-old investor might adopt a 70-30 stock-bond allocation as strategic policy, maintaining that approximate ratio through regular rebalancing while allowing modest drift between adjustment points. This approach reflects long-term risk tolerance and return requirements rather than short-term market views. Tactical asset allocation, by contrast, involves temporary deviations from strategic targets based on market valuations, economic conditions, or other factors suggesting particular asset classes offer superior near-term opportunities. An investor might temporarily increase stock allocation from 70 to 75% when valuations appear attractive, or reduce to 65% when prices seem extended. These tactical shifts require market timing skill to add value, a capability that proves elusive for most investors. Evidence suggests strategic allocation maintained consistently outperforms most tactical adjustment attempts after accounting for transaction costs and the difficulty of correctly timing market movements. Rebalancing restores portfolios to target allocations after market movements cause drift. A 60-40 stock bond portfolio becomes 65-35 after stock gains and bond stagnation, overweighting equities beyond intended levels. Rebalancing sells appreciated stocks and buys underperforming bonds, returning to 60-40. This systematic process forces buy low, sell high behavior, selling assets that have become expensive and purchasing those that have cheapened. Common rebalancing approaches include calendar-based methods, adjusting quarterly or annually regardless of drift magnitude, and threshold-based methods, rebalancing only when allocations deviate beyond specified percentages like 5 or 10% from targets. The optimal rebalancing frequency balances competing considerations. More frequent rebalancing maintains tighter allocation control but increases transaction costs and tax consequences. Less frequent rebalancing reduces costs but allows greater allocation drift and potential risk exposure changes. Research suggests annual rebalancing provides a reasonable compromise for most investors, though those facing minimal transaction costs might benefit from somewhat more frequent adjustments, while high-cost traders should rebalance less often. Correlation coefficients quantify how investments move relative to each other, ranging from -1, perfect inverse movement, through 0, no relationship, to +1, perfect synchronization. Assets with correlations near 0 or negative provide superior diversification benefits compared to those moving in tandem. Stocks and bonds historically exhibit correlations around 0 to slightly positive, meaning they often move independently, though occasionally shift together during market stress. international stocks correlate roughly 0.7 to 0.8 with US equities, high enough that they do not provide complete diversification, but low enough that meaningful benefits exist. Real estate and commodities show weaker correlations with traditional stocks and bonds, typically 0.3 to 0.5, potentially enhancing portfolio diversification. The mathematics of diversification reveal that benefits accumulate most rapidly with initial additions to concentrated portfolios. A portfolio holding a single stock carries maximum company-specific risk. Adding a second uncorrelated stock immediately reduces volatility substantially. A third and fourth stock bring further reductions. However, research suggests that approximately 20 to 30 individual stocks eliminates most diversifiable risk, with additional holdings providing diminishing marginal benefits. Beyond this threshold, portfolios approach market-level risk, unable to reduce volatility further, except through adding other asset classes with different risk characteristics. This relationship explains why broad index funds holding hundreds or thousands of securities do not provide dramatically more diversification than well-selected portfolios of 25 to 30 stocks across different sectors and industries. The additional holdings help ensure no single sector or industry dominates, but the core diversification benefit arrives much earlier. For bond portfolios, similar principles apply, though the optimal number might differ given bonds' generally lower individual volatility compared to stocks. Home country bias describes investors' tendency to overweight domestic investments relative to global market capitalizations. US investors, for instance, typically allocate 70 to 80% or more to domestic stocks, despite US markets representing roughly 50 to 55% of global equity market value. This bias reflects familiarity, perceived reduced currency risk, tax considerations, and regulatory comfort. While some home bias may prove rational given these factors, extreme overweighting creates concentration risk and forgoes diversification benefits from international exposure. Optimal portfolio construction combines these principles into coherent allocation frameworks. Younger investors with decades until retirement might maintain 80 to 90% stock allocations, accepting substantial volatility for higher expected long-term returns. Mid-career investors typically moderate to 60 to 70% equities as retirement approaches and risk capacity declines. Retirees often reduce stocks further to 30 to 50%, prioritizing capital preservation and income generation over growth, though maintaining equity exposure hedges against inflation across potentially lengthy retirement spans of 20 to 30 years. Larger portfolios benefit from greater diversification capacity, potentially including real estate investment trusts, international bonds, commodities, and other asset classes, improving risk-adjusted returns. Smaller portfolios function effectively with simpler structures, perhaps just US and international stock funds plus bond holdings, avoiding the complexity and costs of elaborate diversification across numerous categories. Interestingly, smaller investors often achieve better diversification through low-cost index funds than wealthier individuals who can afford active management but frequently concentrate portfolios in narrower strategies. The way capital allocates across and within asset classes offers insight into investment strategy and risk management beyond what total portfolio value alone reveals. Holdings within portfolios can be structured in various ways, reflecting both deliberate strategic decisions and behavioral patterns that often undermine long-term success. Portfolio holdings arrange themselves according to three general patterns, each reflecting distinct investment philosophies and risk tolerances. Concentrated portfolios focus capital in relatively few positions, typically 10 to 15 individual securities or a narrow set of funds targeting specific sectors or strategies. This concentration amplifies both gains and losses from individual position performance, creating potential for substantial outperformance if selections prove correct or significant underperformance if judgments err. Concentrated approaches suit high-conviction investors, comfortable accepting elevated risk from lack of diversification, gambling that superior security selection compensates for this added volatility. Balanced diversification represents the middle ground, spreading capital across 20 to 40 individual securities or a moderate collection of funds covering major asset classes and sectors without excessive fragmentation. This structure eliminates most company-specific risk while maintaining tractability for monitoring and decision-making. Research suggests this level of diversification captures the majority of available risk reduction benefits without the diminishing returns and increased complexity from holding hundreds of positions. Most financial advisors recommend this balanced approach for individual investors lacking compelling reasons to concentrate or fragment holdings excessively. Over-diversification, sometimes called diworsification, results when portfolios hold so many investments that superior performers get diluted by mediocre ones, while management complexity increases substantially. An investor holding 100 individual stocks or 20 mutual funds covering overlapping strategies achieves little additional risk reduction beyond what 30 stocks or 5 well-selected funds provide. The additional holdings increase costs, complicate monitoring, and virtually guarantee portfolio returns, approximate broad market averages, defeating the purpose of active security selection. This pattern often reflects either misguided beliefs that more holdings always improve outcomes or accumulated purchases over time without strategic pruning of redundant positions. Sector diversification within equity allocations addresses concentration risk from industry-specific events. The Global Industry Classification Standard divides companies into 11 sectors, each responding differently to economic conditions, regulatory changes, and technological disruptions. Information technology currently comprises roughly 28 to 30% of S&P 500 weight as of recent measurements, while utilities represent approximately 2 to 3%. Investors must decide whether to mirror market weightings through broad index funds or deliberately overweight or underweight sectors based on valuations, growth prospects, or personal convictions. Substantial sector deviations from market benchmarks create tracking error and concentrated risk, but potentially generate outperformance if sector views prove correct. Geographic diversification extends beyond domestic markets to include international developed market equities and emerging market exposure. International stocks comprised roughly 45 to 50% of global market capitalization historically, though US dominance has increased recently. Despite this substantial international presence, US investors typically allocate only 20 to 30% of equity portfolios to foreign stocks, exhibiting pronounced home country bias. This domestic overweight reflects multiple factors, including familiarity, regulatory comfort, tax simplicity, and currency risk avoidance. However, extreme home bias forgoes diversification benefits, as international stocks provide imperfect correlation with domestic holdings and exposure to faster-growing economies in regions like Asia. Dollar-cost averaging represents temporal diversification, spreading purchases across multiple time points rather than investing lump sums immediately. An investor directing $500 monthly into an investment over 12 months practices dollar-cost averaging, buying more shares when prices fall and fewer when prices rise. This mechanical approach removes emotional decision-making from purchase timing and avoids the regret of investing large sums immediately before market declines. However, research demonstrates that immediate lump sum investment outperforms dollar-cost averaging roughly 2/3 of the time in rising markets, as delayed deployment sacrifices returns during the waiting period. Dollar cost averaging primarily provides psychological comfort rather than superior mathematical returns, a legitimate consideration for investors who would otherwise delay investing due to market timing concerns. Optimal diversification balances risk reduction against complexity and costs, with appropriate structures varying based on portfolio size, investor sophistication, and personal preferences. Low-cost index funds provide instant broad diversification, making elaborate individual security portfolios unnecessary for most investors. Those pursuing active management should concentrate enough to allow outperformance if selections succeed, while maintaining sufficient diversification to survive inevitable mistakes. While diversification and asset allocation describe portfolio characteristics at specific moments, long-term investment success requires adapting strategies as financial situations and goals evolve throughout life. Investment planning examines how strategies should change over time to align with evolving financial goals and circumstances. Allocation decisions appropriate for a 25-year-old beginning a career differ dramatically from those suitable for a 65-year-old entering retirement, reflecting changes in time horizon, income sources, and risk capacity. These demographic shifts influence both accumulation strategies during working years and distribution strategies during retirement, creating distinct phases requiring different approaches. Life cycle investing adjusts asset allocation based on age and proximity to financial goals. The rule of 110 or 120 provides simple guidance suggesting that stock allocation should equal 110 or 120 minus current age, expressed as a percentage. A 30-year-old following the rule of 110 would hold 80% stocks and 20% bonds, gradually shifting toward more conservative allocations as retirement approaches. A 60-year-old, under this formula, maintains 50% stocks, while a 70-year-old reduces to 40%. This mechanical approach captures the intuition that younger investors benefit from stock market growth potential across extended periods, while older investors require stability to protect capital needed for near-term expenses. The accumulation phase encompasses working years when earned income exceeds expenses, allowing systematic savings directed toward long-term goals. During this period, investors typically emphasize growth over income, accepting volatility in exchange for higher expected returns. Aggressive allocations of 80 to 90% stocks prove appropriate given decades available to recover from market downturns. Monthly contributions through employer retirement plans or automatic investment programs establish discipline while enabling dollar cost averaging across market cycles. The priority during accumulation involves maximizing contributions, particularly to capture employer matching, minimizing investment costs, and maintaining allocation discipline through market volatility rather than abandoning equity exposure during downturns. The preservation phase begins approaching retirement, typically 5 to 10 years prior, when protecting accumulated capital takes precedence over maximizing growth. Portfolios gradually shift toward bonds and cash equivalents, reducing exposure to equity market declines that might devastate retirement plans if occurring just before or early in retirement. This de-risking process, sometimes called a glide path, continues through early retirement years. Target date funds automate this transition, progressively reducing stock allocations as target retirement years approach. Though investors should verify that fund glide paths match personal risk tolerance and circumstances rather than blindly accepting default trajectories. Withdrawal strategies determine how retirees convert accumulated assets into retirement income streams, supplementing Social Security and pensions, if available. The 4% rule, derived from research by William Bengen in the 1990s and subsequently refined through the Trinity study, suggests that withdrawing 4% of initial portfolio value annually, adjusted for inflation in subsequent years, provides high probability of portfolio lasting 30 years. A retiree with $1 million would withdraw $40,000 the first year, then adjust that amount for inflation annually, regardless of portfolio performance. Historical analysis suggests this strategy succeeds in roughly 90 to 95% of 30-year retirement periods, though success rates depend heavily on stock-bond allocation and the sequence of returns experienced early in retirement. Safe withdrawal rates vary with portfolio composition and retirement duration. Aggressive portfolios with 70 to 80% stocks support higher withdrawal rates, around 4 to 4.5%, given their greater growth potential. Conservative portfolios heavy in bonds might sustain only 3 to 3.5% withdrawals safely, given lower expected returns. Longer planned retirements require lower withdrawal rates, perhaps 3 to 3.5% for 40-year horizons, while shorter 20-year retirements might sustain 5%. Current low interest rate environments and elevated stock valuations suggest some researchers advocate for lower withdrawal rates, around 3%, rather than the traditional 4%, though this remains debated. Sequence of returns risk represents one of retirement planning's most significant hazards. Identical average returns produce vastly different outcomes depending on when gains and losses occur. A retiree experiencing losses early in retirement, when portfolio balances are highest and withdrawal percentages therefore represent largest dollar amounts, may deplete assets despite subsequent recoveries. Conversely, early gains provide cushion, enabling portfolios to survive later downturns. This timing luck significantly impacts retirement success, with early retirees facing especially acute sequence risk if markets decline shortly after retirement begins. Strategies mitigating sequence risk include maintaining larger cash reserves covering 2 to 3 years of expenses, allowing retirees to avoid selling stocks during downturns. Dynamic spending approaches reduce withdrawals during poor market years and increase them during strong performance periods, though this requires lifestyle flexibility. Many retirees find difficult. Some retirees delay Social Security benefits until age 70, maximizing monthly payments and creating larger inflation-adjusted income floors, reducing portfolio withdrawal pressure. Together, allocation patterns, strategic planning, withdrawal rates, and sequence risk considerations offer a comprehensive picture of how portfolios sustain investors across multi-decade retirement spans. Time horizon fundamentally shapes appropriate investment strategies, with approaches differing dramatically across life stages, from early career through retirement. Time functions as the critical variable determining appropriate investment risk levels, with extended horizons enabling strategies that would prove disastrous over shorter periods. A 25-year-old can absorb a 50% portfolio decline and recover fully over subsequent decades through continued contributions and compound growth. A 75-year-old experiencing identical losses might never recover financially, as limited remaining lifespan and inability to replace capital through earned income make such declines potentially catastrophic. This fundamental difference in temporal positioning shapes every aspect of portfolio construction across life stages. Young investors in their 20s and 30s possess the most valuable financial asset, rarely appearing on balance sheets: decades of future earning capacity. Human capital, the present value of all expected future earnings, typically exceeds financial capital by substantial margins early in careers. A 25-year-old earning $60,000 annually with $30,000 saved has human capital approaching $2 million, or more assuming wage growth and continued employment over 40 years, dwarfing current financial assets. This dominant human capital position, which resembles bond-like characteristics in providing steady income streams, justifies aggressive financial asset allocation towards stocks for growth rather than income. Recommended allocations for this. Demographic typically reach 85 to 95% equities, with remaining capital in bonds or cash for emergency reserves. Historical data demonstrates that 15-year stock holding periods produced positive returns in virtually all rolling periods since 1926, with longer horizons showing even greater consistency. Volatility that seems terrifying over days or months becomes manageable, even irrelevant, when evaluated across decades. Young investors benefit most from market downturns as continuing contributions purchase shares at discounted prices, accelerating wealth accumulation through dollar-cost averaging during bear markets that destroy value for those withdrawing funds. The prioritization during early career involves maximizing retirement account contributions, particularly capturing full employer matches that represent immediate 50 to 100% returns, impossible to achieve through investment performance. A 401k match of 50% on contributions up to 6% of salary effectively provides a guaranteed 3% compensation increase for participating employees. Failing to capture this match represents financial self-sabotage. Yet surveys suggest roughly 1/4 of eligible workers contribute too little to receive full matching. Mid-career investors in their 40s and 50s experience shifting priorities as retirement transitions from distant abstraction to approaching reality. Human capital declines as remaining work years diminish, while financial capital hopefully grows through accumulated savings and investment returns. The balance between these two forms gradually shifts from human capital dominant to financial capital, representing increasing proportions of total wealth. This progression suggests moderating equity exposure somewhat, perhaps to 70 to 80% stocks, acknowledging reduced time available to recover from severe market downturns. This life stage often involves peak earning years coupled with substantial financial obligations, including college funding for children, elderly parent care, and mortgage payments. The competing demands for current income versus retirement savings create tension, requiring careful prioritization. Generally, retirement savings should take precedence over college funding, given the availability of financial aid and student loans for education versus the absence of such options for retirement income. Parents can borrow for college, but cannot borrow for retirement, making adequate retirement contributions essential despite competing worthy goals. Pre-retirees in their 50s and early 60s face the critical transition from accumulation to preservation mode. With retirement potentially just years away, protection of accumulated capital becomes paramount. A major market decline at age 60 leaves limited time for recovery before retirement withdrawals begin, creating substantial sequence of returns risk. Gradual de-risking toward 50 to 60% stock allocations provides some protection, while maintaining growth potential needed to fund potentially 30-year retirement spans. This transition, while seemingly conservative, reflects appropriate risk management given approaching capital dependence. Behavioral biases represent systematic patterns of irrational decision-making that influence portfolio outcomes as powerfully as asset allocation or security selection. These psychological tendencies, documented extensively through research in behavioral finance and economics, cause investors to make predictable errors that reduce returns and increase risks. The damage proves dynamic and persistent, manifesting during both bull and bear markets across decades of investing experience. Understanding these biases and implementing structural defenses against them separates successful long-term investors from those who consistently underperform despite adequate resources and knowledge. Loss aversion, perhaps the most influential behavioral bias, describes the phenomenon whereby losses feel approximately twice as painful as equivalent gains feel pleasurable. Research by Daniel Kahneman and Amos Tversky, work that earned Kahneman the Nobel Prize in Economics in 2002, quantified this asymmetry through experiments revealing that people demand roughly twice as much potential gain to accept risks of equivalent losses. This psychological imbalance causes investors to hold losing positions too long, hoping to avoid realizing losses, while selling winners prematurely to lock in gains and avoid the possibility of those gains reversing. The result? Systematically poor timing that reduces returns compared to buy and hold strategies, maintaining positions through volatility. Annual performance gap studies comparing fund returns to investor returns within those same funds reveal the cost of poor behavioral timing. Dalbar research consistently shows that investor returns lag fund returns by 2 to 3 percentage points annually on average, representing the difference between fund performance calculated on buy and hold basis and actual dollar-weighted returns accounting for investor cash flows in and out of funds. Investors tend to purchase funds after strong performance and sell after declines, the exact inverse of profitable behavior. This pattern, repeated across millions of individual decisions, destroys substantial wealth that would otherwise compound over decades. Confirmation bias describes the tendency to seek information supporting existing beliefs while dismissing contradictory evidence. An investor convinced that technology stocks offer superior returns notices every article praising innovation and disruption while ignoring warnings about excessive valuations or competitive threats. This selective perception creates echo chambers, reinforcing initial positions regardless of changing circumstances. Online communities and social media amplify this effect, connecting like-minded individuals who validate each other's views and dismiss outside perspectives as uninformed or biased. The investor operates with false confidence, believing extensive research supports positions when that research consists primarily of agreeable information rather than balanced analysis. Recency bias weights recent events disproportionately compared to longer-term historical patterns. After experiencing strong stock returns for several years, investors extrapolate recent performance indefinitely, despite mean reversion tendencies documented across market history. Conversely, following severe bear markets, investors project continued losses despite stocks' historical recovery patterns. This causes buying at market peaks when enthusiasm runs highest and selling at troughs when pessimism dominates, again, the inverse of profitable timing. The bias proves particularly destructive because it feels rational in the moment, recent experiences providing vivid emotional evidence that overwhelms statistical analysis of longer periods. Anchoring occurs when initial information establishes reference points that irrationally influence subsequent decisions. An investor purchases stock at $50 per share, establishing that price as an anchor. When shares fall to $40, the investor refuses to sell at a loss, waiting for recovery to the $50 anchor, despite objective analysis suggesting the business deteriorated and $40 might prove generous. Similarly, stocks purchased at $50 that rise to $70 get sold to lock in gains, with the $50 anchor preventing recognition that the stock might reasonably reach $100 based on improved fundamentals. The arbitrary purchase price, which contains no information about intrinsic value, dominates decisions that should focus exclusively on current valuations and future prospects. Herd behavior and bubbles demonstrate collective irrationality, amplifying individual biases into market-wide distortions. The dot-com bubble of the late 1990s exemplifies this process. Initial internet company success attracted attention and capital. Rising prices drew more investors seeking similar gains. Media coverage intensified as technology stocks dominated headlines. Traditional valuation metrics were dismissed as outdated for new economy companies. Analysts developed novel metrics like price to eyeballs and price to clicks, justifying valuations untethered from earnings or revenues. Skeptics were ridiculed as failing to understand transformative change. The feedback loop accelerated until prices reached absurd levels, then collapsed when reality reasserted itself, and profits proved necessary for sustainable valuations. Similar patterns recur across market history, from the tulip mania of 1630s Holland through the housing bubble of the mid-2000s to various cryptocurrency and meme stock episodes. Each iteration brings participants convinced that this time is different, that new paradigms justify ignoring historical valuation relationships. Each eventually proves that fundamental economics still govern, that prices must eventually relate to underlying cash flows and asset values. The cycle persists because new generations of investors lack experience with previous bubbles, and because profits during early bubble phases create powerful validation of speculative behavior, at least until reversals devastate late participants. Overconfidence causes investors to overestimate their knowledge, abilities, and the precision of their predictions. Surveys consistently show that over 80% of drivers rate themselves as above average, a mathematical impossibility revealing systematic overestimation of competence. Investors demonstrate identical patterns, believing they possess superior analytical skills, better information access, or keener market timing abilities than evidence supports. This overconfidence drives excessive trading as investors act on perceived insights, generating transaction costs and taxes while rarely producing returns justifying the activity. Studies of brokerage account data reveal that the most active traders achieve the lowest returns after accounting for costs, yet persist in believing their activity adds value. Mental accounting describes the tendency to treat money differently based on arbitrary categories rather than fungibility. An investor maintains separate mental accounts for safe retirement funds and speculative trading capital, taking wild risks in the trading account while being excessively conservative in retirement accounts, despite both pools serving the same ultimate purpose of funding retirement. Similarly, investors spend capital gains freely as found money, while treating original principal as sacred, despite both representing identical financial resources. These artificial distinctions lead to suboptimal allocation decisions that reduce overall portfolio efficiency. The sunk cost fallacy causes investors to continue commitments based on past expenditures rather than forward-looking analysis. An investor purchasing stock that declines might buy more shares to average down the cost basis, throwing good money after bad based on prior losses rather than objectively assessing current prospects. Alternatively, investors hold on to losing positions because selling would require admitting mistakes and realizing losses, even when capital could be redeployed more productively elsewhere. Past costs, being irretrievable, should not influence decisions about future allocations, yet they exert powerful psychological influence, driving continued commitment to failing strategies. Strategies for overcoming behavioral biases rely primarily on structural mechanisms that remove discretion during emotional periods. Automatic investment programs establish systematic purchasing that continues regardless of market conditions, preventing the paralysis that keeps investors on sidelines during volatility. Rebalancing on calendar schedules forces selling appreciated assets and buying depreciated ones, mechanically imposing buy low, sell high discipline, contrary to emotional impulses. Target date funds and robo-advisors automate allocation decisions, removing temptation to deviate based on market timing or recent performance. These mechanical approaches work not through superior market insight, but by preventing behavior-driven errors that human discretion enables. Written investment policy statements documenting asset allocation targets Rebalancing rules and decision criteria provide guardrails during emotional periods when deviation from plan becomes tempting. Reviewing these predetermined guidelines during market stress reminds investors that current circumstances were anticipated and planned for, reducing the feeling that immediate action is required. The act of committing to policies during calm periods, when rational analysis dominates, helps override emotional reactions during turbulent markets, when panic or euphoria might otherwise drive poor decisions. Working with financial advisors provides external perspective that can counterbalance behavioral tendencies. A professional can discourage selling during market bottoms or curtail excessive risk-taking during euphoric bull markets, offering judgment unclouded by the emotional attachment portfolio owners experience. The advisor also serves as accountability partner, making deviation from plan harder through need to justify decisions to another person rather than simply acting on impulse. Not exactly comfortable when resisting the urge to sell during market downturns, but effective for investors who maintain discipline despite powerful emotional pressures driving them toward costly mistakes. In all of these cases, whether through automated systems, predetermined policies, or external guidance, behavioral finance demonstrates that investment success is not purely about identifying attractive securities or timing markets. It represents an ongoing psychological challenge, driving adaptation through structural defenses against the self-inflicted wounds that destroy returns on both sides of bull and bear markets in an endless financial arms race against human nature. Resources including capital, time, and opportunities remain finite for every investor. When multiple financial goals compete for limited savings, when fees claim portions of returns, and when taxes reduce net wealth, strategic prioritization becomes essential. Investment costs directly reduce returns, with even modest percentage differences compounding into substantial wealth destruction over decades. Expense ratios, management fees, transaction costs, and taxes each claim portions of portfolio growth, functioning as permanent drags on accumulation. Each investor occupies a cost structure determined by fund selections, trading frequency, account types, and advisory relationships, with total costs ranging from under 0.1% annually for passive index investors to 2% or more for those combining active management with frequent trading. Mutual fund expense ratios represent annual fees charged as percentages of assets, covering management, administrative, and operational costs. Broad market index funds from providers like Vanguard, Fidelity, and Schwab now charge as little as 0.03 to 0.05% annually, competition having driven costs to near zero levels. Actively managed equity funds average closer to 1.0 to 1.2%, with some specialty funds exceeding 1.5%. Bond fund expense ratios typically fall 0.3 to 0.5 percentage points below equity fund costs, given simpler management requirements. These differences appear modest in isolation, but accumulate dramatically through compounding effects. Consider an investor placing $100,000 into two funds with identical 8% annual returns before fees. Fund A charges 0.05%, while Fund B charges 1.0%. After 30 years, Fund A grows to approximately $955,000, while Fund B reaches only $743,000, a difference of $212,000 or 28% less accumulated wealth. Fund B must generate returns roughly 1 percentage point higher annually just to match Fund A after accounting for fee differences, a performance edge that proves extraordinarily difficult to maintain consistently. Research examining thousands of funds across decades reveals that low-cost funds outperform high-cost peers on average, with few expensive funds justifying their costs through superior returns. Management fees for financial advisory services typically range from 0.5 to 1.5% of assets under management, with many advisors charging 1.0% for accounts in the $250,000 to $1 million range. This fee structure sits on top of underlying investment costs, meaning an investor paying 1.0% advisory fees while holding funds averaging 0.5% expense ratios faces combined costs of 1.5% annually. Alternative fee structures include hourly rates of $150 to $400 per hour, flat annual retainers of $2,000 to $10,000 depending on complexity, or project-based pricing for specific planning needs. Each structure suits different circumstances, with assets under management fees proving most expensive for large portfolios, while potentially offering better value for those requiring ongoing guidance and emotional support during market volatility. Transaction costs, including trading commissions and bid-ask spreads, once represented substantial barriers to frequent trading. Commission-free stock trading at major brokerages has largely eliminated explicit trading costs for retail investors, though bid-ask spreads persist, particularly for thinly traded securities. More significantly, frequent trading triggers short-term capital gains taxed at ordinary income rates rather than preferential long-term rates, converting 20% tax obligations into 37% for high earners. This tax differential between short and long-term holding periods creates powerful economic incentives for patience. Beyond simple preference for lower activity, tax drag extends beyond trading-triggered capital gains to annual taxation of dividends and interest in taxable accounts. Municipal bond investors in high tax brackets might effectively face 0% taxation on interest income, while corporate bondholders pay ordinary income taxes reaching 37% federally, plus state taxes potentially adding 5 to 13%. The after-tax return differences dwarf most other cost considerations for high-income investors, making asset location strategy, placing tax-inefficient investments like bonds in retirement accounts, while holding tax-efficient investments like index funds in taxable accounts, critical for tax optimization. Front-end loads charge sales commissions on mutual fund purchases, typically 3 to 5%, immediately reducing invested capital. A $10,000 purchase with a 5% load invests only $9,500, requiring 5.3% gain just to return to even. Back-end loads charge fees on redemptions, often declining over holding periods through contingent deferred sales charges. 12b1 fees permitted up to 1% annually compensate brokers and pay marketing expenses, functioning as hidden ongoing sales charges. The proliferation of no-load funds and commission-free ETFs has made load funds increasingly difficult to justify economically, though some investors still purchase them through commission-based advisors whose compensation structures incentivize recommending higher-cost products. This way, cost competition does not always lead to exclusion of expensive options. Through specialized services, active tax management, and behavioral coaching value that prevents costly mistakes, some higher fee investments and advisory relationships can justify their costs for specific investors. Still, for most pursuing long-term wealth accumulation, minimizing expenses through low-cost index funds and tax-efficient account structures remains the most reliable path toward financial success, capturing the maximum possible percentage of market returns rather than surrendering substantial portions to intermediaries. Tax strategy represents another dimension of wealth optimization, one where intelligent planning can add value, rivaling or exceeding investment returns themselves through reduced tax obligations and improved compounding. Now write the next section following the outline, matching its target word count. Before writing, review your custom style guide from reference script 1. The outline details for this specific section how you just ended the previous section. Avoid repeating those patterns. Where this section transitions to next, write pure script. No labels, bullets, stage directions, or meta-commentary. Just narrative prose. Mandatory checks as you write. Voice consistency. Emotional temperature matches. Reference script. One narrator perspective matches attitude towards subject and audience matches. Structural integrity. Opening pattern. Different from previous section, body follows reference script 1's organizational flow. Closing pattern. Different from previous section transition style. Different from the one you just used. Sentence and paragraph. Length variety matches. Reference script 1. No identical sentence openers, 3+ times in a row. At least one single sentence paragraph, if appropriate. Rhythm matches reference. Clusters builds breathing room. Word choice and tone. Use reference script 1's favored language. Avoid what reference script 1 avoids. Match vocabulary level and figurative language frequency. Tone calibration, exact signature patterns, strategic use. If a pattern appears 40% in reference, use it 40% here, not 100%. Check, did I use this pattern in the previous section? If yes, rest it. Vary transition types: comparative, causal, temporal, thematic, question-based, anti-mechanization. No repeated closing formulas. No templated structures throughout. Ask, would reference script 1 writer vary more here? If yes, mix it up. Word count must match outline target within 5%. Final drop-in test. Would this be indistinguishable from reference script 1? Does this sound like reference script 1 read aloud? Would the reference writer recognize their voice? If no to any, revise before delivering. Now write the next section. Investment portfolios demand systematic evaluation beyond simple account balance monitoring, requiring analysis of both individual holdings and overall portfolio characteristics. Understanding how to assess security values and portfolio metrics enables informed decisions about maintaining, adjusting, or replacing positions as circumstances change. Both structure, the types and sizes of securities held, and dynamics, how portfolios evolve over market cycles and life transitions, require attention. Fundamental analysis examines company financial health and valuation through metrics derived from financial statements and market prices. The price-to-earnings ratio, calculated by dividing share price by annual earnings per share, provides the most commonly referenced valuation measure. Historical averages for the S&P 500 center around 15 to 16, meaning investors traditionally paid roughly $15 to $16 per dollar of annual corporate earnings. Current market PE ratios fluctuate with interest rates, growth expectations, and sentiment, ranging from single digits during severe pessimism to 25 or higher during optimistic periods. Individual company ratios span even wider ranges, from under 10 for mature slow-growth businesses to over 50 for high-growth technology companies. The P/G ratio, price to earnings divided by expected earnings growth rate, attempts to account for growth differences across companies. A stock with a PE of 30 and expected growth of 15% annually carries a PEG of 2.0, while one with a PE of 20 and growth of 10% also has a PEG of 2.0. PEG ratios below 1.0 traditionally suggest undervaluation relative to growth prospects, while ratios above 2.0 indicate potential overvaluation, though these thresholds serve as rough guidelines rather than precise signals. Price-to-book ratio compares market value to accounting book value, the net assets shown on balance sheets. Technology and service companies often trade at high price-to-book multiples given minimal physical assets and substantial intangible value from brands, patents, and intellectual property. Financial institutions and manufacturers with substantial tangible assets typically show lower price-to-book ratios, sometimes below 1.0 during distressed periods. Technical analysis studies price patterns and trading volumes, seeking to identify trends and momentum that might predict future movements. Moving averages, support and resistance levels, and various momentum indicators attempt to extract signals from price history. Academic research generally finds limited evidence supporting technical analysis effectiveness in efficient markets, though some practitioners claim success particularly in shorter timeframes. For long-term investors focused on fundamentals, technical analysis typically provides marginal value compared to understanding business, economics, and valuations. Bond analysis emphasizes different metrics than equity evaluation. Duration measures interest rate sensitivity, expressing approximate percentage price changes for 1% yield moves. A bond with 7 years duration falls roughly 7% if yields rise 1%, or gains approximately 7% if yields fall 1%. Longer maturities and lower coupons produce higher duration, meaning greater interest rate risk. Credit quality, assessed through rating agency grades, determines default risk and appropriate yield spreads over treasuries. Yield to maturity incorporates coupon payments, purchase price relative to par value, and time until maturity into a single return measure, assuming the bond is held to maturity and all payments are received as scheduled. Portfolio level metrics assess overall risk and return characteristics beyond individual holdings. The Sharpe ratio divides excess return above the risk-free rate by standard deviation, quantifying risk-adjusted performance. Sharpe ratios above 1.0 indicate attractive risk-adjusted returns, with ratios above 2.0 representing excellent performance. However, the Sharpe ratio assumes normal distribution of returns and may understate risk during periods exhibiting extreme tail events that occur more frequently than normal distributions predict. Alpha measures returns exceeding what would be expected given portfolio risk level, representing skill-based outperformance rather than simply accepting higher risk. Positive alpha suggests manager talent or investment edge, adding value, while negative alpha indicates underperformance, even after accounting for risk taken. Most actively managed funds generate negative alpha after fees, explaining the difficulty of justifying active management costs for typical investors. Beta quantifies volatility relative to overall market movements. Beta of 1.0 means the portfolio moves in line with market averages. Beta above 1.0 indicates greater volatility and sensitivity to market moves, amplifying both gains and losses. Beta below 1.0 suggests lower volatility and more stable performance. Due diligence before purchasing investments involves examining fund prospectuses, manager tenure and track records, fee structures, and portfolio composition. For individual securities, analysis extends to financial statements, competitive positioning, management quality, and business model sustainability. Red flags include frequent management turnover, deteriorating profit margins, rising debt levels without corresponding revenue growth, accounting irregularities, and substantial insider selling. No single indicator proves definitive, but accumulating warning signs justify heightened scrutiny or position avoidance. Rebalancing triggers determine when portfolios require adjustment back toward target allocations. Calendar-based approaches rebalance quarterly or annually, regardless of drift magnitude, providing simplicity and discipline, but potentially excessive trading costs. Threshold-based methods rebalance only when allocations deviate beyond specified percentages, perhaps 5 or 10% from targets, reducing trading frequency while allowing some drift. Hybrid approaches combine elements, checking allocations quarterly, but rebalancing only when thresholds are breached. The optimal method balances allocation control against transaction costs and tax consequences, with higher cost or taxable accounts justifying less frequent rebalancing, while low-cost tax-advantaged accounts benefit from tighter control. Together, fundamental metrics, portfolio-level measurements and systematic due diligence demonstrate how investors evaluate the portfolios they construct, sometimes identifying strengths supporting continued holdings, other times revealing weaknesses demanding position changes or risk adjustments. Portfolios evolve continuously rather than remaining static, changing through market movements, life transitions, and deliberate adjustments as investors refine strategies and adapt to shifting circumstances. Creating a personal investment plan transforms general principles into actionable strategies aligned with individual circumstances, goals, and constraints. These plans emerge gradually rather than appearing fully formed, sometimes developing from initial small steps, sometimes requiring reconstruction after financial setbacks. The changes involved, referred to as portfolio development, can arise from deliberate planning, market movements, or life events like career changes, marriages, births, or inheritances. While some portfolios maintain relatively stable structures across years, others undergo dramatic reshaping through major transitions. The process begins with assessing current financial positioning, establishing baseline understanding of income, expenses, assets, debts, and existing savings. This financial inventory reveals available capital for investment, monthly savings capacity, emergency fund adequacy, and problematic debt requiring attention before significant investing begins. High-interest credit card balances carrying 18 to 25% rates demand payoff before directing funds toward investments unlikely to match those return requirements consistently. Student loans at 6 to 8% occupy middle ground, with reasonable arguments supporting either accelerated payoff or parallel investing, depending on risk tolerance and loan tax deductibility. Goal definition follows initial assessment, translating vague aspirations into specific financial targets with defined time horizons and required capital. Retirement might require accumulating $1 million to $2 million over 30 to 40 years. Home down payment goals could target $60,000 to $100,000 within 5 to 7 years. Education funding for children might aim for $100,000 to $200,000 per child over 15 to 18 years. These concrete targets enable calculation of required savings rates and expected investment returns needed to reach objectives, transforming abstract intentions into mathematical requirements that either prove feasible or demand goal modification. Risk tolerance assessment determines psychological capacity for volatility, typically through questionnaires probing reactions to hypothetical loss scenarios and examining past behavior during market stress if applicable. A 25-year-old claiming high risk tolerance who panicked during minor 2022 market declines demonstrates that stated tolerance exceeds actual behavioral tolerance, requiring more conservative allocation than initially contemplated. This self-awareness, though sometimes painful to acknowledge, prevents allocation mistakes that lead to selling during downturns and locking in losses. Initial asset allocation emerges from combining time horizon, risk tolerance, and goal requirements into appropriate stock-bond cash mixes. Young investors with 30-plus year horizons typically settle on 80 to 90% stock allocations, absent unusual risk aversion. Mid-career investors might prefer 60 to 70% stocks balancing growth needs against increasing proximity to goal dates. Conservative investors, or those nearing goal dates, often choose 40 to 50% stocks, emphasizing preservation over growth. No allocation universally suits all situations, requiring individualized analysis rather than template application. Account selection determines where investments will reside, optimizing tax treatment and accessing employer benefits. Most employees should begin with 401k or 403b plans, at minimum capturing full employer matches, essentially free money despite investment and access restrictions. After securing matches, IRA contributions often follow, providing broader investment options and potentially lower costs than employer plans. Taxable brokerage accounts supplement retirement accounts for near-term goals or after maximizing tax-advantaged contribution limits. Health savings accounts warrant consideration for those with qualifying high-deductible health plans given triple tax advantages rivaling or exceeding traditional retirement accounts. Implementation involves opening selected accounts, funding them through initial deposits, and establishing automatic contributions, then purchasing investments matching target allocation. For most investors, simple approaches work effectively. A 3-fund portfolio holding US Stock Index Fund, International Stock Index Fund, and Bond Index Fund provides broad diversification at minimal cost, requiring perhaps 30 minutes annually for rebalancing and tax reporting. Target date funds simplify further by combining all asset classes in single investments, adjusting automatically as target years approach, though at marginally higher costs than self-managed 3-fund portfolios. The first investments, often just employer plan selections with first paycheck, represent pioneer holdings, establishing initial market exposure despite modest amounts. Over time, their growth, combined with continuing contributions, helps create an investment foundation that supports larger positions and more sophisticated strategies if desired. Gradually, the portfolio evolves from these simple beginnings into more substantial accumulations as contributions and compounding build wealth. Monitoring and rebalancing schedules provide ongoing maintenance without excessive intervention. Annual reviews suffice for most investors, checking whether allocations drifted beyond tolerance thresholds and whether life changes demand strategy modifications. Quarterly reviews suit those preferring more frequent attention, though risking behavioral mistakes from over-monitoring and reacting to normal short-term volatility. The discipline involves assessing situations objectively rather than emotionally, recognizing that downturns represent opportunities for continuing contributions to purchase shares at discounts rather than crises demanding portfolio abandonment. Life event adjustments recognize that static strategies eventually misalign with changing circumstances. Marriage combines 2 financial plans, requiring coordination of account types, allocation decisions, and goal priorities potentially differing between partners. Children introduce education funding considerations and often temporary income reductions during parental leave, affecting savings capacity and timelines. Career changes might improve or reduce earnings, shift employer benefit access, or trigger retirement account rollovers, requiring decisions about consolidation versus maintaining multiple accounts. Home purchases draw down savings, redirecting future contributions from investment accumulation toward mortgage principal reduction for some households. Major markets downturns, the financial equivalent of wildfires, may devastate portfolios, but also create opportunities for disciplined investors. Those continuing contributions during downturns purchase shares at depressed prices, positioning for substantial gains during eventual recoveries. Rebalancing forces selling appreciated bonds to buy beaten-down stocks, imposing buy-low discipline, contrary to emotional impulses favoring flight to safety. The investors maintaining positions and systematically rebalancing through 2008-2009 or March 2020 ultimately recovered and prospered, while those selling near bottoms locked in permanent losses that subsequent gains never repaired for them. Recognizing when to seek professional guidance versus managing independently depends on portfolio complexity, personal interest, and ability and behavioral tendencies. Simple situations, young investors with modest assets and long horizons often manage effectively through low-cost target date funds requiring minimal ongoing decisions. Complex situations involving substantial assets, multiple account types, tax optimization opportunities, and estate planning considerations might justify professional assistance despite added costs. Behavioral coaching value, preventing panic sales or encouraging adequate equity exposure despite fear, sometimes proves worth advisory fees, even when investment management itself adds little. Through these cycles of planning, implementation, monitoring, and adjustment, investment portfolios demonstrate resilience and capacity to adapt across market volatility and life changes, though always constrained by individual risk tolerance, time horizons, savings capacity, and the discipline to maintain strategies through inevitable turbulence, rather than abandoning plans during precisely the moments when perseverance matters most. The debate between active and passive investment management represents one of investing's most fundamental strategic choices, dividing approaches between those attempting to beat market returns through security selection and those accepting market returns through low-cost index fund ownership. In financial markets, these investment philosophies coexist continuously, and the interactions among practitioners pursuing each approach influence price discovery, market efficiency, and ultimate investor outcomes. Active management seeks outperformance through identifying mispriced securities that will deliver returns exceeding broad market benchmarks. Active managers analyze financial statements, evaluate management teams, assess competitive dynamics, and synthesize economic trends into investment decisions selecting specific stocks or bonds expected to outperform. This approach assumes markets price securities inefficiently, often enough that skilled analysis can identify opportunities before prices adjust, generating alpha that justifies management fees and trading costs. The strategy requires belief that informational or analytical edges exist and can be maintained despite competition from thousands of other professionals pursuing similar advantages. Passive management accepts market returns through index fund ownership that replicates broad benchmarks like the S&P 500 or total market indices. This philosophy derives from efficient market hypothesis, suggesting that prices already incorporate available information, making consistent outperformance extraordinarily difficult after accounting for costs. Passive investors acknowledge inability to reliably identify winning securities or managers in advance, instead capturing market returns at minimal expense. The approach prioritizes cost minimization over outperformance attempts, recognizing that average dollar invested earns average returns minus costs, making below average costs a mathematical path toward above average net results. Evidence strongly favors passive approaches for most investors. SPY vs scorecards tracking active fund performance against benchmarks reveal that 80 to 90% of US large-cap equity funds underperform the S&P 500 over 15-year periods after accounting for fees. International and small-cap categories show similar patterns, with slight variations in exact underperformance rates. These results reflect not individual manager incompetence, but rather the mathematical reality that active management collectively represents the market, making average active returns equal market returns before costs. After subtracting fees averaging 1% compared to index funds at 0.05%, active managers face structural disadvantages requiring outperformance of roughly 1 percentage point annually just to match passive alternatives. The compound effect of this fee differential proves substantial across decades. An investor directing $100,000 into an index fund charging 0.05% that tracks market returns of 8% accumulates approximately $996,000 over 30 years. The same investor in an actively managed fund charging a 1.0%, assuming identical gross returns, accumulates only about $743,000, a difference of $253,000, or roughly 34% less wealth. the active fund must generate 1 percentage point higher gross returns annually, achieving 9% while the market delivers 8% to match the index fund's net outcome, a consistent performance edge few managers sustain. Behavioral costs compound fee disadvantages for active investors. Research shows investors in actively managed funds underperform the funds themselves by 2 to 3 percentage points annually on average due to poor timing of purchases and sales. This behavior gap reflects tendencies to chase past performance, buying funds after strong recent returns that subsequently regress toward means, and selling after poor performance that often precedes recoveries. Index fund investors exhibit similar poor timing behaviors, but to lesser degrees, perhaps because passive investment philosophy inherently discourages the active decision-making that enables timing mistakes. Circumstances where active management might add value include inefficient market segments, like emerging market equities or small-cap stocks, where informational advantages prove easier to obtain and exploit. Tax loss harvesting in taxable accounts provides another active management benefit, potentially adding 0.5 to 1.0% annually through strategic realization of losses offsetting gains. However, direct indexing strategies now enable tax loss harvesting without traditional active management, capturing this benefit while maintaining passive exposure. Some investors value behavioral coaching from advisors who prevent panic selling during downturns, a service potentially justifying fees even if investment management itself adds minimal value. For the vast majority of investors across most circumstances, passive index fund investing through broad market exposure at minimal cost provides the most reliable path toward financial goal achievement. The approach acknowledges that beating markets proves extraordinarily difficult, that identifying future outperformers before their outperformance occurs remains nearly impossible, and that costs matter tremendously in determining net outcomes. By accepting market returns rather than attempting to exceed them, passive investors paradoxically position themselves ahead of most active investors whose efforts and expenses leave them behind, despite superior intentions and significant effort. The accumulation of evidence supporting passive approaches has triggered substantial asset flows from active to passive strategies over recent decades, with index funds and ETFs now capturing trillions in assets and majority shares of new investment dollars. This shift reflects investor recognition of active management's aggregate failure to justify costs despite individual fund success stories that prove statistically inevitable within large populations, even if randomly distributed rather than skill-based. Behavioral biases introduce psychological forces into investment decisions that operate as powerfully as mathematical relationships between risk and return, often overwhelming rational analysis during periods of market stress or euphoria. These cognitive and emotional patterns, documented through decades of behavioral finance research, create predictable errors that compound across repeated decisions and extended time periods. The self-inflicted damage proves persistent regardless of intelligence, education, or investing experience, affecting novice and sophisticated investors alike through mechanisms operating largely outside conscious awareness. Loss aversion, among the most influential behavioral tendencies, stems from asymmetric emotional responses to gains versus losses. Research by psychologists Daniel Kahneman and Amos Tversky, foundational work in behavioral economics that earned Kahneman the 2002 Nobel Prize, quantified this psychological asymmetry. Their experiments revealed that losses feel approximately twice as painful emotionally as equivalent gains feel pleasurable. A $1,000 loss generates roughly twice the negative emotional impact, as a $1,000 gain produces positive feeling, creating fundamental imbalance in how humans process financial outcomes. This imbalance manifests in portfolio management through reluctance to sell losing positions, as realizing losses creates acute psychological pain that holding declining investments somehow avoids despite identical economic realities. Investors cling to poor performers, hoping for recovery to break-even points that become anchors, preventing rational assessment of current prospects. Simultaneously, winning positions get sold prematurely as investors seek to lock in gains and eliminate risks of those gains evaporating, a behavior called selling winners, keeping losers, that systematically undermines returns by eliminating exposure to best performers while maintaining or increasing exposure to worst. Confirmation bias describes systematic tendencies to seek information supporting existing beliefs while dismissing or ignoring contradictory evidence. An investor convinced about particular stock prospects notices every positive article, analyst upgrade, and favorable data point while rationalizing away negative information as temporary setbacks, misunderstandings, or deliberate manipulation by short sellers. This selective perception creates echo chambers where initial views strengthen through biased information processing, regardless of objective reality shifts. Social media and online investing communities amplify confirmation bias by connecting like-minded individuals who validate each other's perspectives and collectively dismiss skeptical, outside views as ignorant or biased. The result is false confidence built on selectively curated information that feels like thorough research but represents systematic filtering rather than balanced analysis. Investors operate believing they have examined evidence comprehensively when they have actually processed only information fitting predetermined conclusions. This proves particularly dangerous because the bias operates unconsciously, with investors sincerely believing their analysis objective when systematic filtering has rendered it anything but. Recency bias weights recent experiences disproportionately compared to longer historical patterns, a tendency that proves particularly destructive given markets' cyclical nature and mean reversion characteristics. Following several years of strong stock returns, investors extrapolate recent performance indefinitely, despite historical evidence that strong periods alternate with weak ones. Conversely, after severe bear markets, investors project continued declines despite stocks' consistent long-term recovery patterns. This creates buying at market peaks when enthusiasm runs highest and recent experience suggests continued gains, then selling at troughs when pessimism dominates and recent experience suggests further losses, the precise inverse of profitable timing. The bias feels rational because recent events provide vivid emotional experiences that dominate abstract statistical analysis of longer periods. The 2008 financial crisis remains seared into memory for those experiencing it, generating visceral fear during any market decline, regardless of how different current circumstances might be from 2008 conditions. Similarly, the long bull market from 2009 to 2020 created confidence that stocks always recover quickly, an expectation not necessarily justified by prior market history, including extended recoveries requiring many years. Anchoring occurs when initial information establishes reference points that irrationally influence subsequent decisions despite containing no relevant information about appropriate values. A stock purchased at $80 establishes that price as an anchor. When shares decline to $60, many investors refuse to sell at a loss, waiting for recovery to the $80 anchor, despite objective analysis suggesting the business deteriorated and $60 might prove generous given changed circumstances. The arbitrary purchase price, which reflects conditions at that specific moment rather than current or future valuations, dominates decisions that should focus exclusively on forward-looking prospects from current prices. Herd behavior and market bubbles demonstrate collective irrationality amplifying individual biases into market-wide price distortions disconnected from fundamental values. The technology bubble of 1999 through early 2000 provides a vivid example. Initial legitimate excitement about internet potential attracted capital and drove prices higher. Rising prices attracted more investors seeking similar gains, creating self-reinforcing feedback loops. Traditional valuation metrics were dismissed as obsolete for new economy companies, despite centuries of evidence that profits ultimately determine sustainable values. Skeptics faced ridicule for failing to understand transformative change. Analysts developed novel metrics like price to eyeballs, justifying valuations untethered from any historical relationship to revenues or earnings. The mania continued until it couldn't, collapsing when reality reasserted itself and companies without paths to profitability could no longer attract capital at any price. The Nasdaq Composite Index fell roughly 78% from peak to trough between March 2000 and October 2002, destroying trillions in market value and devastating portfolios concentrated in technology stocks. Similar patterns recur throughout financial history, from tulip mania in 1630s Holland through the housing bubble of the mid-2000s to periodic cryptocurrency and meme stock manias. Each iteration brings participants convinced this time is different, that new paradigms justify ignoring valuation discipline. Each eventually demonstrates that fundamental economics still govern outcomes. Overconfidence causes systematic overestimation of knowledge, abilities, and prediction accuracy. Surveys consistently reveal that over 80% of people rate themselves above average drivers, a mathematical impossibility highlighting universal tendencies towards self-flattery. Investors demonstrate identical patterns, believing they possess superior analytical skills, better information, or keener market timing abilities than evidence supports. This overconfidence manifests through excessive trading as investors act on perceived insights, generating transaction costs and taxes while rarely producing returns justifying the activity. Studies analyzing brokerage account data reveal that the most active traders achieve the lowest returns after costs, yet persist believing their activity adds value because occasional successes reinforce confidence, while failures get rationalized as bad luck or temporary setbacks. Mental accounting treats money differently based on arbitrary categorizations rather than recognizing fungibility. An investor might maintain conservative retirement accounts while taking wild risks in a separate speculative trading account, despite both ultimately serving identical purposes of funding future consumption. Similarly, investors spend capital gains freely as house money, while treating original principal as sacred, despite both representing identical purchasing power. These artificial distinctions lead to suboptimal overall portfolio allocation that reduces risk-adjusted returns through inefficient capital deployment across mental buckets. The sunk cost fallacy causes continued commitment to failing strategies based on prior expenditures rather than forward-looking analysis. An investor purchasing declining stock might buy additional shares to average down the cost basis, throwing additional capital at deteriorating situations based on prior losses rather than objectively assessing current prospects. Alternatively, investors hold losing positions because selling requires admitting mistakes and realizing losses, even when capital could be redeployed more productively. Past expenditures being irretrievable should not influence forward decisions, yet they exert powerful psychological influence, driving continued resource commitment to failing courses. Defense mechanisms against behavioral biases rely primarily on structural approaches that remove discretion during emotional periods when judgment proves most unreliable. Automatic investment programs purchasing securities systematically, regardless of market conditions, prevent paralysis that keeps investors sidelined during volatility when opportunities often prove best. Rebalancing on predetermined schedules forces selling appreciated assets while buying depreciated ones, mechanically imposing buy low, sell high discipline, contrary to emotional impulses favoring the opposite. Target date funds and robo-advisors automate allocation and rebalancing decisions, eliminating opportunities for counterproductive tinkering. Written investment policy statements, documenting allocation targets, rebalancing thresholds, and decision criteria serve as commitment devices during emotional periods when deviation from rational plans becomes tempting. The statements prepared during calm periods when rational analysis dominates remind investors that current turbulence was anticipated and planned for, reducing feelings that immediate dramatic action is required. Professional financial advisors provide the external perspective, unclouded by emotional attachment, that portfolio owners experience, offering judgment during periods when investor psychology most powerfully pushes toward destructive behaviors. In all cases, whether through automated processes, predetermined policies, or external guidance, behavioral finance illustrates that investment success transcends identifying attractive securities or timing markets skillfully. It represents an ongoing psychological challenge requiring structural defenses against self-destructive tendencies that manifest during precisely the moments when disciplined adherence to rational strategies matters most for long-term wealth accumulation. The competition investors face is not primarily against other market participants, but against their own behavioral tendencies that consistently push toward buying high, selling low, overtrading, and abandoning carefully designed strategies during the market conditions that test them most severely. Investment portfolios are intricate systems defined by both structure, the types and proportions of securities held, and dynamics, the way these holdings evolve through market cycles and deliberate adjustments. Understanding both aspects proves essential for maintaining portfolios aligned with goals while adapting to changing circumstances. At the foundation of many successful portfolios are core holdings, investments that establish fundamental market exposure and provide stability through various market conditions. Core holdings typically consist of broad market index funds covering major asset classes, providing diversified exposure at minimal cost while requiring little ongoing attention. A US total stock market index fund establishes domestic equity exposure across thousands of companies and all market capitalizations. An international developed market fund adds geographic diversification beyond US borders. A total bond market index fund provides fixed income ballast and income generation. These three positions, properly sized according to age and risk tolerance, form complete portfolios for millions of investors, demonstrating that sophistication and complexity prove unnecessary for effective wealth accumulation. Portfolio diversity, the range and distribution of holdings, takes multiple dimensions into account. The number of different securities, their sector and geographic distribution, and evenness of position sizing all contribute to diversification effectiveness. A portfolio of 30 stocks spread across all 11 economic sectors provides far superior diversification compared to 30 technology stocks concentrated in a single industry despite identical position counts. Similarly, a portfolio allocating 10% to each of 10 positions exhibits better diversification than one with 50% in a single stock and 5% in each of 10 others, though both contain 11 holdings. Species richness, translated to investment terms as the total number of distinct holdings, tends to increase benefits up to certain thresholds, beyond which additional securities add minimal value. Research suggests that 20 to 30 individual stocks eliminate most company-specific risk for equity portfolios, with marginal benefits from additional holdings. For bond portfolios, similar principles apply, though optimal numbers might differ given generally lower individual security volatility. Broad index funds effectively provide unlimited diversification through hundreds or thousands of holdings, making the question of optimal security count largely irrelevant for investors pursuing passive approaches. Beyond quantity, the role specific holdings play within portfolios proves crucial. Keystone positions, investments exerting disproportionate influence on portfolio characteristics relative to their size, deserve particular attention. A 25% allocation to small-cap value stocks in an otherwise large-cap growth portfolio significantly alters overall risk-return characteristics despite representing just 1/4 of capital. Similarly, a 10% allocation to real estate investment trusts or commodities can substantially reduce correlation with traditional stock bond portfolios, providing diversification benefits exceeding what position size alone might suggest. Inappropriate investments, securities misaligned with portfolio objectives or risk tolerance, can destabilize carefully constructed allocations. A conservative investor holding high volatility individual stocks or sector-specific funds introduces risks inconsistent with overall strategy. An aggressive growth-oriented portfolio containing substantial cash positions or low-yield bonds sacrifices potential returns without corresponding benefits. These misalignments often result from accumulated purchases over time without strategic pruning, creating portfolios that evolved haphazardly rather than following coherent plans. Fundamental analysis examines individual security characteristics to assess appropriate valuations and holding suitability. Price-to-earnings ratios, comparing share prices to annual earnings per share, provides simple valuation measures averaging 15 to 16 for broad markets, historically though varying substantially across companies and periods. Growth companies often trade at PE ratios of 25 to 40 or higher, reflecting expectations of substantial earnings expansion. Value companies might show PE ratios of 8 to 12, suggesting either undervaluation or genuine business challenges limiting growth prospects. Technical analysis studies price patterns and trading volume seeking to identify trends that might predict future movements. Moving averages, support and resistance levels, and momentum indicators attempt to extract actionable signals from price history. Academic research generally finds limited evidence supporting technical analysis effectiveness in efficient markets, though practitioners claim value particularly in shorter timeframes. For long-term investors, technical considerations typically matter less than fundamental business quality and valuations. Portfolio-level metrics assess overall characteristics beyond individual holdings. The Sharpe ratio quantifies risk-adjusted returns by dividing excess returns above risk-free rates by portfolio standard deviation. Ratios above 1.0 indicate attractive risk-adjusted performance. Alpha measures skill-based outperformance beyond what portfolio risk levels would predict. Beta quantifies volatility relative to market averages, with beta of 1.0 representing market-level volatility and higher values indicating greater sensitivity to market movements. Rebalancing decisions benefit from systematic approaches, removing emotional judgment. Calendar-based rebalancing quarterly or annually provides simplicity, though potentially excessive trading in volatile markets. Threshold-based approaches rebalancing only when allocations deviate beyond specified percentages, perhaps 5%, reduce trading frequency while maintaining reasonable allocation control. The optimal method balances costs against allocation discipline, with tax-advantaged accounts justifying more frequent rebalancing given absence of tax consequences. Together, core holdings, diversification metrics, valuation analysis, and systematic monitoring demonstrate how investors maintain portfolios aligned with objectives while adapting to evolving markets and personal circumstances. Understanding these elements separates reactive emotional portfolio management from disciplined systematic approaches that weather market cycles and life transitions more successfully. Portfolios evolve continuously as investors implement initial plans, adapt to market movements, adjust for life changes, and refine strategies based on experience and shifting priorities. Building a personal investment plan begins at different starting points for different individuals. Some commence with no existing investments, creating portfolios from scratch with initial contributions from early paychecks or windfalls. Others rebuild after financial setbacks, job losses, divorces, or market crashes that depleted previous accumulations. Still others inherit established portfolios, requiring evaluation and potential restructuring to align with their own goals and risk tolerances rather than previous owners' circumstances. Each origin point demands slightly different approaches, though fundamental principles remain consistent across situations. Starting from zero capital represents primary portfolio development, analogous to colonizing bare financial ground. The first investment, perhaps a simple target date fund through an employer 401k plan, functions as a pioneer holding establishing initial market exposure despite modest size. These early positions, chosen for accessibility and simplicity rather than sophistication, create foundations that support more elaborate structures as capital accumulates. A 22-year-old contributing $200 monthly to a 2065 target date fund has begun the process regardless of how unsophisticated that single fund approach might seem compared to complex multi-asset portfolios held by experienced investors. Over time, continuing contributions combined with investment growth help build more substantial positions. Initial 401k holdings might be supplemented with IRA contributions once employment stabilizes and income increases. Employer matching accelerates accumulation, effectively doubling contribution rates up to match thresholds. Annual raises enable increased savings rates without lifestyle sacrifices, perhaps moving from 6% of salary to 8%, then 10% or more as earning power expands. Gradually, the investment portfolio evolves from these simple beginnings into more significant accumulations, potentially incorporating taxable brokerage accounts, health savings accounts, or 529 education plans as needs expand beyond basic retirement savings. Rebuilding after financial disruption constitutes secondary portfolio development, recovering from setbacks that damaged but did not entirely eliminate financial progress. A market crash might reduce account values 40 or 50%, devastating psychologically, even if the underlying investments remain sound. Job loss could force premature retirement account withdrawals, incurring taxes and penalties while interrupting accumulation. Divorce often divides assets, resetting individuals to fraction of previous joint wealth. These disruptions, while painful, need not prove permanently destructive. The financial foundations, knowledge of investment principles, established savings habits, and remaining capital set stages for recovery through disciplined rebuilding. The recovery process emphasizes continuing regular contributions that purchase shares at depressed prices following market declines. Investors maintaining discipline through 2008, 2009, or March 2020, adding to positions when fear dominated, positioned themselves for substantial gains during eventual recoveries. Those who panicked and sold, converting paper losses into permanent realized losses, never recovered that specific capital regardless of subsequent market performance. The willingness to continue contributing and rebalancing through turbulence separates successful, long-term investors from those who abandon strategies during precisely the periods when perseverance matters most. Matured. portfolios eventually reach optimization, achieving allocations and positions that match goals, risk tolerance, and circumstances effectively. These established structures, analogous to climax ecological communities, maintain relative stability absent major disruptions or life changes. A 55-year-old with $800,000 allocated 60% to diversified stock index funds and 40% to bonds, rebalanced annually, has reached a mature state requiring only minor adjustments for contribution additions and periodic rebalancing. The portfolio functions smoothly, generating expected returns without demanding constant attention or frequent strategy changes. However, even optimized portfolios require periodic evaluation as circumstances evolve. Marriage introduces partners' financial situation, potentially requiring consolidation of duplicative accounts and reconciliation of different risk tolerances or investment philosophies. Children trigger education funding considerations and temporary income disruptions during parental leave. Promotions or career changes might improve savings capacity substantially or eliminate employer retirement plan access, necessitating IRA rollovers and restructured contribution strategies. Home purchases redirect capital from investment accumulation toward down payments and later toward accelerated mortgage payoff versus additional investing, a tension without universal correct answers. Market crashes function as portfolio wildfires, temporarily devastating values, but ultimately enabling renewal through disciplined response. Rebalancing during downturns forces selling bonds that held value while buying beaten-down stocks at depressed prices, establishing positions poised for recovery gains. The 2008-2009 financial crisis offered a vivid example. Investors who rebalanced by selling bonds near 40% portfolio weights to restore 60-40 stock bond targets effectively sold bond highs to buy stock lows, positioning for the subsequent bull market that more than recouped losses for those who maintained positions. Those who instead sold stocks near lows to feel safer missed the recovery's most powerful initial phase, potentially never recovering psychologically even as markets eventually exceeded previous peaks. Knowing when to adjust strategies versus when to maintain course despite doubts or market turbulence represents portfolio management's most challenging judgment. Major life changes approaching retirement, new children, health issues clearly warrant review and potential adjustment. Market volatility alone, absent change personal circumstances, rarely justifies abandoning well-designed allocation strategies. The temporary discomfort of seeing account balances decline tests investor discipline, but should not trigger strategy overhaul absent genuine changes to risk capacity, time horizons, or goals themselves. Professional guidance proves most valuable during these decision points, providing external perspective on whether adjustments genuinely serve long-term interests or represent emotional reactions likely to prove counterproductive. The advisor functions not primarily as investment genius, identifying superior securities, but as behavioral coach, preventing wealth-destroying mistakes during periods when doing nothing proves psychologically hardest, but often strategically optimal. This coaching value, though difficult to quantify, sometimes justifies advisory fees that pure investment management might not. Through these cycles of initial development, market-driven fluctuations, life event adjustments, and disciplined maintenance, investment portfolios demonstrate resilience and capacity for wealth accumulation across decades despite inevitable volatility and disruptions. Though success remains contingent on maintaining discipline during turbulent periods, rather than abandoning strategies when emotional pressures push toward counterproductive responses that feel comforting in moments but prove destructive across the extended timelines that determine ultimate financial outcomes.